Good evening. On behalf of the entire team at Edelweiss Mutual Fund, welcome to our annual house, and we hope that wherever you're watching this from, you and your families are safe and happy. As some of you know, we started our open house series at Edelweiss Mutual Fund last year. As an organization, transparency is very important to us, being open to our investors and partners about what we do, how we manage your hard earned money, how our investment philosophy is shaping up, and how we've been managing your money is important. This is our second annual open house in this series. FY22 was a very special year for us, and it was not just a special year because of the kind of asset growth and investor growth we saw. It was a year where we have invested, no pun intended, in strengthening our investment team across each category today. At Edelweiss, we are driving an investment-first culture and a lot of innovation in product, something that you guys keep writing to us, our distributor and investor community. At the asset management level today, we are now a 22-member investment team, which includes CIOs, fund managers, analysts, and dealers. And today you'll get a chance to talk to many of them, interact with many of them, and we hope that you'll enjoy that interaction. For us, from a fund point of view, our focus has always been on delivering consistency in fund performance and placing utmost importance on risk management. Today, we are going to spend time talking about our core investment philosophy and how we manage money in each of the asset classes and funds. Many of you have seen the agenda, but some of the things that we will cover is our long-only funds, followed by our international funds, our hybrid funds, and fixed income funds. And of course, we are very excited to take all your questions, so keep them coming in. Another critical focus for us as a fund house will be evolving our investment approach around things like ESG. We'll talk about how we're driving ESG in our funds on the equity conversation. But as an organization also, we are committed to ESG in many different ways. And you'll keep hearing more about that and many initiatives in things like our annual report. Last year was also a special year for us because of the growth and awareness that we've seen in a category that's very close to our heart, and that is debt passives and target maturity funds. Started with Bharat Bond, and we are delighted to be a leader in that space. We've now built this basket of target maturity funds across various maturities to serve your needs, and we'll be having a conversation later today about everything that is happening in fixed income, the environment about interest rates, and of course, how you can use these target maturity funds to fulfill your fixed income goals. We are also committed to improving our digital properties and making it easier for you to both understand our funds and buy funds. So we've been working to build robust and strong digital platforms for both investors and partners. Of course, that's always work in progress. Some of you may know that we've recently launched our mobile app, eInvest for Investors. If you haven't checked it out, we absolutely encourage you to, and we welcome all the feedback that comes there. eInvest not just enables transactions, but is also a hub for the content that many of you like, including podcasts, book summaries. So please go check eInvest out. And finally, I think equipping our investors and partners with updated and interesting knowledge is an area that we've been focusing on for the last few years. We often get comments on book summaries and some of the initiatives we do, and we really welcome that. We've consistently been doing the Connect series in the form of webinars. We introduced Connect School to do live training sessions, and we've got some fantastic feedback on the training sessions we're doing. There's interaction that we're having with you on mediums like Twitter Spaces, where our fund managers and our leadership team has been present. And we look forward to engage both in the online and offline format. With that, let's get started with the open house. As I said, the format is well known. We'll have 4 sets of sections. We will take questions at the end of each section. So whether it's equity, hybrid, fixed income, or international, keep your questions coming in, and we promise to take all of them. If there are questions that we cannot take in the middle of the sections, then we will take those questions at the end, where the entire team will be present to take all your questions. So keep asking, and we're looking forward. Once again, on behalf of the entire team at Edelweiss Mutual Fund, to all our investors and partners, thank you for your exceptional support in the last 1 year and over the last many years. And we look forward to what the coming year will bring. With that, what we'll do is I will invite our long-only equity team so that we can kick off the first section. Welcome to our first session on equities, long-only equities. I'd like to start by introducing Trideep Bhattacharya, who is our CIO Equities, and his entire team is here. I won't introduce the team because I will ask Trideep to introduce the team. But we have lots of questions for the team, and we'll be taking your questions on long-only equities also at the end of this session, so keep them coming. Trideep, I'll start with the first question to you. So, 2 questions. Stock picking is, of course, both an art and science both. It'll be great if you can do 2 things. One is talk a little bit about how you blend this art and science in your investment philosophy, our investment philosophy, and the process we follow while picking businesses. Also, since we've expanded the equity team here, it will be great if you can start by explaining and introducing the team and explaining how the team is structured.
Thanks, Radhika, for your question. Good evening, everyone, and hope all of you can hear. And it's great to be, and I think open house session is a great session to sort of talk about the views that we have, how we orient ourselves, and B, also get some feedback or questions, so keep them coming. But going back to the question that Radhika asked, that the philosophy and the process, I must admit that at the heart of it, we all know that equities are volatile, and performance today is strong, tomorrow could be weak. But the key thing that we stand for is the investment philosophy and the process that we follow. That, in my opinion, is something that we want to build in as a fabric for not only for 1 year, 2 year, for a good time to come. And hence, this is the most important question to sort of start the session with. And allow me a latitude of about 4 or 5 minutes to take a bit of time to understand this, to tell you all about this, because it is important. It's important because this is what we do, this is what we want to stand for, and it's important that you appreciate, and we'll be more than happy to take questions on that. So we actually call our investment philosophy fair. And as we coined the term and as we thought about it, it's probably the fairest way of picking stocks in our opinion. So what does it really stand for? So 4 parts to it. F stands for forensics, A stands for acceptable price, I stands for ESG aware, and R stands for robustness. Now, on the face of it, that might look like slightly MBA-ish. Let me kind of put a thread around all of these to kind of make it clear what we really want to say here. So at Edelweiss MF, we are at the end of the day bottom-up stock pickers. So as bottom-up stock pickers, how do we kind of enhance our focus? How do we get to the right set of companies so that we can deliver consistent returns over a period of time for investors? This is what we do using FAIR. So to put it in the form of a necklace, I would say that we are interested in basically financially clean companies. And that's the forensics part. Second, that can grow sustainably. This is the ESG part. Third, we are interested in robust business models Companies that are present in scalable opportunities, and management can take advantage of that, not only in terms of growth, but also profitability as well as return ratios. So not just growth, but profitability and return ratios are also important. And finally, as investors, they should be available to us at an acceptable price. So that's basically FAIR, the investment philosophy that we stand for. And trust me, over the last 6-7 months that we have sort of articulated this more clearly, the performance and various different things that have followed. As you hear a lot of my colleagues talk about this, you will find that there is a bit of consistency that is coming around. A lot more to go, but that's as a starting point. So in order to do justice to the investment philosophy and process, one of the things that both myself and Radhika, we sat together and kind of was very clear to us that fund management should be a mix of fund management and sectoral expertise. It can't be just fund managers and analysts being separate. And that is basically the thinking process behind how we have structured our equities team, all of you that you see over here on the stage. So let me start with the leftmost person. His name is Sahil Shah. He's an old-timer at Edelweiss MF. He is the co-portfolio manager of mid-cap fund, runs the small-cap fund for us, and also as far as sectoral expertise is concerned, his expertise lies in consumer discretionary and chemicals. Over 14 years of experience into equities and in the sectors that we talked about, apart from fund management. Let me kind of introduce then Abhishek Gupta, who recently joined us from Goldman Sachs Asset Management. Apart from being the fund manager for large and mid fund, his sectoral expertise spans almost more than a decade in industrials, IT sector, and a few other sectors as well. So fairly experienced person as much as you can get. And then let me come to the person on my right, Mehul Dalmia, who is probably the newest, not probably, is the newest member of our team. And this is a part of, it represents a part of analysis which I am particularly quite excited about, particularly given what we plan to do here. His focus is likely to be going forward on ESG, on forensics and quantitative analysis. We'll elaborate more on detail as we kind of talk along various different aspects of what we want to do in this. But let me tell you, the forensics is such an important part of our analysis. It's almost like a 1-0 tool in our investment philosophy. In other words, particularly for mid and small cap companies, which are two of our bigger funds, we find that if the companies don't match the forensics profile, in other words, are not financially clean, something that I described as part of our investment process, we actually don't invest in that. So that's how critical it is. That's how critical his role is. And the important thing that you see in this is all of them not only are fund managers, but also in some form analysts as well. Even I look at consumer staples and a couple of other sectors. So overall, we are all stock pickers. That's what we want to stand for. That's what our investment philosophy is all about. And hope over a period of time, as we speak to you in various different forums, this comes out loud and clear.
Thanks, Tradeep. So before I get to, and we'll spend time talking to the team as you've introduced them on specific funds and deep dive into funds. But maybe I could start with a more general question. For investors, I think your thoughts on current market events. Of course, it has been a first half of the year of volatility, and I know there was a year-end note we wrote to this effect. More than current market events, I think how we are playing various themes across the portfolio. And I think what also investors would be concerned about in these volatile times is which are the areas where you and the team are extra cautious while picking businesses?
Yep, that brings us to the current market conditions. But before we go there, I think in the answer to the last question, I covered basically in a nutshell what we do in the way we go about picking stocks. I wanted to spend, before I answer your question, in terms of what we don't do. That's also equally critical. And will come out as a lot of us speak. The first thing that we don't do is basically, take macro calls. Our portfolios are not really oriented around whether Modi will come on power or Yogi ji will come on power, but it's more oriented about how the bottom of earnings of the companies would stand to do. That's number one. Second, we don't take outside sector bets. And that's something that we have agreed as policy across all the portfolios, and hence we want to let our stock picking do the work. And third, we don't take cash calls. We believe that the distributors or the community that represents on the other side of the table today, they have taken a view based on which they have allocated money to us to manage. And we want to put it to work in the best possible way in the best possible companies that can generate returns. We don't want to second guess their portfolio allocation call as well. So that's something very important in terms of what we wanted to cover. Now let's come to the market view and the lay of the land. I would say that in a nutshell, India today, in the context of the last 10 years that have been for India, and India today in the global context, in both these circumstances, this is the best position that India has ever been. Let me first talk about India in the context of the last 10 years. In my opinion, there are three things which are happening in India which are particularly interesting to note. First of all, there is a good chance that we will see a private sector capex happening in India, something that has not happened in the last 10 years or even more. Second, we think we could well be in the first 2 years of bottoming out of the real estate cycle. Real estate, apart from just equity markets, is genuinely boon for the overall economy as it causes employment and various different good things that come along with it. And third, for all of you listening who are employed, for the first time in the last 15 years, we've seen salary hikes come through which are in double digits, something that we haven't seen in the last 15 years. Last 15 years has been more, single digits. So all in all put together, if I put together all of these three and look at it from the medium term or 2 to 3 year perspective, there are really 4 themes that we are quite bullish about and are well represented across our portfolios. So much so that as we all speak, hopefully that comes out. First of all, we are bullish on a rebound in credit growth. We think as the economy turns around, there will be a rebound in credit growth, and financials is a good way to go play this in our portfolios. Second, an even bigger call is basically our call on private capex cycle. We think that playing through industrials and allied sectors is a good way to leverage of the situation that we have in India, and the portfolio should stand to benefit from the same. Third, we are also positive on real estate and both direct plays as well as indirect plays like building materials and stuff like that. And finally, and actually quite importantly in the context of last 10 years, for the first time we find that the government has struck a positive chord with the private sector. These have been in the form of PLI schemes. They have also been in the form of various other stands that the government has taken, maybe in the context of Russia, this, that, the other, which I think could be genuinely beneficial for some of our portfolio companies that we have handpicked in our portfolios as well. So those would be the themes, Radhika, that we would be kind of positive on. It has rub off on multiple sectors, but we think it's a good way to put together a bunch of bottom-up portfolios. That's what we think.
Thanks, Tradeep. I think what we'll do now is cover 4 of our funds in some level of detail. So Sahil, I'll start with you and I'll come to Edelweiss Small Cap Fund. Now that is one of the newer funds in the long only basket, but it's also completed a wonderful 3-year track record and a little more. So Sahil, can you tell us briefly about Edelweiss Small Cap Fund and talk also about what has contributed last year to the performance, and importantly, how is the portfolio positioned currently in terms of theme sectors?
Sure. Thank you for the question. So in terms of the objective of the fund, or the philosophy of the fund, it is quite in sync with what Trideep also mentioned, that we look for companies which are expected to grow at a fast rate, companies which have a good corporate governance track record and do have a robust business model. So this quite aligns with our FAIR framework, which Trideep also talked about. In the small cap space, what is more important is the forensics part. Because apart from growth, it is the quality of earnings that also matters a lot. And it is all about how we filter out from the universe of small and mid caps, which is typically around 400 odd companies, to around 150 to 100 companies, which becomes our investable universe, from where we pick our and choose those stocks in the portfolio. So it is the quality of earnings that matter the most. In fact, if we look at the companies which have generated a lot of alpha or have been so-called multi-baggers, a lot of it has come from PE re-rating. And PE re-rating has happened primarily on the back of good quality of earnings growth and not alone growth of earnings. So that's what our core philosophy of the fund is. Now talking about which sectors have outperformed over last 1 year. For us, it has been IT, industrials, and auto parts have contributed to our returns. In terms of the themes that we like at the current stage, as Trideep also mentioned, China plus one theme is one of the themes that we believe has a growth which is going to continue for next 5 to 10 years. And I'll just spend a couple of minutes to explain on how we think about China plus one. In small and mid caps, you find a lot of companies in the chemical space. In fact, in 2015, the move from China to India had started to happen as China had banned a lot of polluting industries, including chemicals. In the ensuing years, the customers also wanted to diversify out of China, and that led to a lot of growth and a lot of capex in the chemical companies in India. Chemicals was always the forte for Indian companies, specialty chemicals. There were a lot of capabilities in the Indian context, and hence when customers started looking out of China, a lot of business came to India, and it is still coming to India. So if I look at the global chemical market, it is around $800 billion, out of which around 4% is captured by India, almost 15% is captured by China, or even more by China. So a small swing which comes out of China results into a massive earnings growth for the Indian companies. Also, the other theme that where we find a lot of opportunities, long-term opportunities in the small and mid-cap space is consumer discretionary, where we have companies which starts from automobiles, auto parts, to air conditioners, to washing machines, to apparels, and the quasi-consumer companies which are into the building material space. So in fact, if we look at the penetration of ACs in India, it is at a very, very low level. China sells almost 6-7 times more air conditioners than India does. In building material space, for emerging segments like MDF, which is a replacement of wood, China sells 15 times more MDF than India. So there is a long runway for such kind of businesses, and these businesses are a part of the small cap space.
Thanks, Sahil. Tradeep, I'll come to you on the next fund. Sahil gave us, a quick overview both of how last year looked for small cap. He talked about China plus one, especially in the context of going forward positioning. If you could move to Flexi Cap Fund, which is of course a fund that has the mandate to move across market caps, and give us a brief take on both the last year and the road ahead for Edelweiss Flexi Cap Fund.
Yeah, I think particularly in mid and small cap, the way we played the chemicals theme and the way we played some of the consumer discretionary themes have been really good for us, and we have some picks even going forward which look quite good. On the flexi cap context, at the end of the day, all the funds which are ultimately in some form or the other is fair at work. So we have this investment philosophy which is not just a philosophy to sit there. It's kind of ultimately applied in different market cap ranges, which is and concoction of those stocks is what you see in the individual portfolios, right? In mid and small cap is what you see relevant to the mid and small cap area. But similarly, in the context of flexi cap fund, this fund has the flexibility to play across market caps and not get constrained or not get bothered about where majority of the opportunity lies. In many ways, it maximizes the opportunity that exists across market cap ranges. So there are many things to sort of cover in terms of how the sectors that have done well for us. I think a couple of things that I wanted to highlight here, which we are playing through in this fund, is number one, the rebound in credit growth. Sometime towards the back half of last year, we realized that overall the corporate deleveraging cycle in India is really in the final stages. And hence, in that context, the last time this happened was in 2004, 2005, when banks subsequently saw a massive re-leveraging cycle and did quite well over a period of time. Not just banks, a couple of other sectors as well, but banks as well. We picked on that, and basically based on that, that changed our portfolio positioning with regards to on the financial side, particularly on the lending financials. So since then, while credit growth in India was at the bottom, lurking around 5 to 6%, it has subsequently moved to 8 to 9% as of the data that came about, or 10% as of the data that came about day before. And we think there is meaningful room for further expansion over the next 1 to 2 years. So a good part of our call, or a good part of our portfolio is reflected in, particularly in FlexiCap Fund, in the form of overweight lending financials. And I think so far we have reaped some benefit of it, but we think that there is more to go over a period of time. The second area that I would highlight is basically household capex, or something that I covered as a theme earlier that we are positive on with regards to bottoming out of real estate sector. Now, if you really look at it, the real estate sector is a tiny bit in the benchmark, with only a few developers coming through. But if you look at it from an indirect play standpoint, we have quite a few portfolio holdings which cater to the real estate sector in an indirect way. So in many ways, if you think about real estate developers as hairstyles, we have picked some barbers in our portfolios, which benefit depending on whichever real estate developer wins. The barbers, in a sense, people who service these companies or these real estate developers would stand to do well. So building materials, tiles, and these are some of the areas that we are particularly positive on and well reflected in the FlexiCap portfolio from a forward-looking standpoint. Hopefully, in the next 2 to 3 years, as they show their merit, that results in better returns.
Thanks, Trideep. Abhishek, I'll move to you on our next fund, popular fund. This is Edelweiss Large and Mid Cap Fund. Again, if you could tell us briefly about the fund and its mandate, talk about what contributed to performance last year, and most importantly, how is the position going? How is the fund positioned going forward in terms of themes and sectors?
Thanks, Radhika, for the question. I think to start with, I'll touch upon what is the investment objective with which we are working in this fund. So the aim is to create long-term capital appreciation, which is going to focus on a risk-adjusted return basis, focusing on diversification, which is the key mandate. But given the nature of the fund, we like to focus our ownership towards large and mid-cap, because we truly believe in being true to the ideology with which we are working with. Now, before I move on to what we own and what we don't own, I'd also like to re-emphasize the aspect of the investment process that we run, right? So Pradeep did highlight that FAIR is the backbone of our investment philosophy. And I mean, I cannot emphasize more on that. Clearly, we live by that. Also, the fact that we believe or we trust our ability to assess businesses from a fundamental perspective. And what does it lead to is helps us from the perspective of creating a portfolio, which has the benefit of both diversification as well as finding the right fit for the portfolio, and hence creating a more holistic approach towards portfolio creation. I think what is relevant to focus here on is that it's an investment process driven selection when it comes to the stocks. And how does it help is it not only reduces the subjectivity which one would have without running on a process, but also helps us in orienting us construct of the portfolio, which is more kind of focused towards the fundamental aspect. So clearly it kind of takes away the individual subjectivity to a great extent. Now coming to how we kind of structure our fund right now and what we own. So clearly, I think one of the key aspects which is seen a theme across our portfolio ownership is the domestic capex recovery theme, which we are kind of trusting on. And there are various subparts to it. So let me touch upon a few of the aspects which we like there. The first aspect is clearly what we are hearing is that whole data center related capex which we're hearing. The fact that the government is emphasizing on those aspects, wants more localization aspects. Now, there's a good data point to start with. I mean, if you look at the number of mobile subscribers which are there in India, and I just kind of use Europe as an example to compare and contrast, we are almost 2x of the overall Europe as a continent, the mobile subscription base in India. But when you talk about the data centers which are available, which is also a backbone for that, you're barely at 10% of the European data center numbers, right? So clearly what I'm alluding to is that there is so much of room to spend in that space. And clearly, just going by the latest numbers which are available, you're talking about almost $14 billion of capex which already being committed in that aspect. So that's one theme which we like right now. The other theme which clearly I think is the talk of the town is this PLI-linked incentive-based schemes. Now, again, there are numbers which are still coming out. These schemes are still getting rolled out. But the last updated data which we have suggests that we're talking about possibly a $50 billion cumulative capex which will be spent over the next 5 years. And this capex will not only help in job creation, because we are possibly looking at upwards of 35 lakhs in terms of the overall job creation opportunity which will play out with this capex which is linked, but also talking about possibly annualized revenue run rate of about $100 billion per annum to be added because of the PLI schemes. And this clearly sets the tone that when we're looking at just not only India, but also a good global sourcing hub, PLI takes a very strong center stage to that aspect. Lastly, the private investment, which also is something which has been lagging for a while. But the good news here is that we have seen, if you look in terms of the overall capex commitments or the private capex needs, it's already double of what you have seen prior to COVID. I'm not even using COVID as an example, because obviously those were disruptions which were in no one's control. Another aspect here is that within the private capex, the manufacturing and subsectors like chemicals, steel, and numerous sectors, they're talking about investments which are tune of anywhere between 3 to 5x. So that's clearly another theme where the private capex returns is something which we're liking. And lastly, but clearly another aspect which needs to be focused here is the whole industrial automation piece. We all are talking about IoT 4.0, we're talking about 5G, we're talking about benefits of that coming from the manufacturing process. But then there are few companies which have got technology to enable that aspect. And again, that's another area which we are liking. We all have talked about what we like, what we don't, but I think it's also worth mentioning there is another aspect. It's something like technology. That's a space where we have been bullish for a while. But to be fair, recently, we have turned a little bit cautious on that. I thought it's worth highlighting here, then again, the aspect which was earlier alluded to by Pradeep, that you're seeing a strong wage, the strong benefit of that, also has a negative rub-off of an IT, because ultimately these companies are kind of finding it hard not only to take care of the attrition rate and take care of delivery, but also there is a risk in terms of how you manage your profitability. So that's one space where we incrementally turn a little cautious, and that's how broadly the structure of the fund is right now, Radhika.
Thanks, Abhishek. And we'll come to the last fund that we are covering here, which is the largest fund in the long-only space. That's Edelweiss Mid-Cap Fund, and this one has a long track record. So, Tradeep, if you can talk about the mid and small cap space again, what has contributed to the performance of this fund and how we are looking at positioning going forward?
Sure. I think I think mid-cap as a category, if you look at emerging markets and wealth creation that happens in emerging markets over a long period of time, which is 10, 15 years, not just 1 or 2 years, I think the wealth creation is something that happens in these two categories more often than otherwise. Now the fact is, in the mid-cap categories, you have companies who have evolved from being small cap to slightly ahead of the curve with regards to, have seen some scent of success, if I may use that word. And they are now basically in a rip-roaring phase where hopefully the growth takes over the next 4 or 5 years before they become the large cap. So in many ways, the mid and small cap are a good catchment area for investors who are looking to kind of, looking for alpha creation over a long period of time, over the next 5 to 10 years. And I think, knock on wood, so far, we have been able to do justice to that category overall. In the small cap, in the small and in mid cap, one of the unique things that we have is basically being true to label, and it's worth highlighting here. Unlike other places where kind of, where the large cap component could be higher or this, that, the other, we have decided to focus on, when we say mid cap, we mean mid cap. So, that's one thing that has kind of helped us being true to label in terms of holding our performance through the cycles. Now, going further a little deeper with regards to the areas that we are positive on that has contributed and going forward, I think in one of the big things that we are positive on the mid cap side is of course the chemical sector where Sahil covered the same. But one of the things that has really held us well in good state over the last 2 or 3 years has been a play on the government growth scheme. Now, obviously I can't take the name here, but just to put a bit of context, about a couple of years ago, if someone were to set up shop in India, did you know that the tax rate that someone had to do that, for someone to do that was as high as about somewhere between 30 and 35%. Whereas, if the same company were to set up shop in, let's say, Thailand, Indonesia, or some of the other emerging parts of Asia, that would have been about 15 to 20%. What a big difference. Now, a couple of years ago, this was changed, and incremental capacity could come in India at tax rate of about 15% or so. This was the first big change which actually kind of augured quite well. Just give me 1 second. There you go. That actually rubbed off quite well for the corporate sector. Subsequent to that, when the government actually announced the PLI schemes cut across multiple sectors, there was one which kind of did, outsourced manufacturing for quite a few customers, and that really took off over the last couple of years. Growth rates in north of 100%, and has a long, tailwind of growth going forward as well. So, as I said, mid cap and small cap, mid cap in particular or small cap, is a hotbed of bottom-up stories. So this was one story, or there are a couple of stories that we have played on this side, which have played on, overall. One is the PLI scheme, which I gave an example about. The other example that I could talk about was basically the so-called the importance of investment in defense. Over the last 2 years, one of the global things that have been happening, which we caught on slightly early, was basically you are seeing more and more nationalistic governments coming through in various different parts of the world. And as a result of that, the defense budgets of various different countries have gone up. And you might have noticed that the domestic component of that has been increasing over a while as well. So we hooked on to this trend a little earlier. And we capitalized on this through a few of our holdings, and have benefited nicely from the same. So I could go on and on. At the end of the day, the mid cap fund is not a thematic fund. It's ultimately it's full of bottom-up stories like 2 that I mentioned, and there are many more that we can kind of talk about. But I'll leave it at 2, and hopefully we can flow on.
Terrific, and actually there are so many questions I would have, and I think the audience questions are coming in. If we have time, it'll be great to cover more of the stories that you, Sahil, and Abhishek all alluded to. But Pradeep, the last question I want to take from you is about the evolution of the investment process. Now, I think one thing that's very important for investors to know is that while there is an investment process, we constantly have to get better at what we do. New business models come to market, the environment around us changes. So our investment process is not static, it has to constantly evolve. Can you talk about how you guys want to evolve the investment process in the future? And some of this is, guys, work in progress. So I think we don't have all answers, but it's also important to tell you about the spaces and areas that we are exploring. So Tradeep, if you could just touch on the evolution of the existing investment process in the future, especially on forensics and ESG, which you touched upon in the FAIR framework, and what the plans ahead are.
Thanks, Radhika. This is part of the process which I am particularly excited about. And I'm excited about because it is very important, particularly in the context of research in emerging markets. And I mean, I'm not trying to kind of, mince words here. Having managed money in developed markets and emerging markets, one of the big things, particularly because of our larger funds are mid and small cap, one of the important areas that we focused on, which Sahil also touched upon, is forensics. Forensics is so important to us that it's a 1-0 tool. In case, basically, what it means is looking a company beyond the P&L, the balance sheet, or the cash flow, and trying to take a holistic view with regards to various stakeholders, and see where it comes out, and whether it still stands the merit of investment or not. Now, this as an area in general is a very evolving area in the context of India. So, forensics as a stream is one such concept. The second concept is basically ESG, and the environmental aspect of the external cost in economic parlance is something that that is another thing that that's just about evolving overall. And third is the intertwining of fundamental and quant. So a bit of quantitative analysis with regards to sharpening our decision-making skills on the fundamental side. So with that background, we recently joined by Mehul, joins from Axis, MF, about a couple of months ago now, overall. And we are shaping this part of the investment team, which is more forward-looking in nature. As Radhika mentioned, that overall, we don't claim to have all the answers. We will evolve over time. But I also want you to know that this is going to be an extremely important part of investment process, let's say 3, 4, 5 years in time. And we don't want to be late in that. We want to be evolved probably ahead, at least in line. So with that, let me bring in maybe Mehul, if you want to talk about what are we planning to do on the ESG side and whatnot.
Thanks, Sudeep. So, ESG is at a very interesting and an important juncture today. when I look at both India or when I look internationally, we are seeing a lot of consolidation happening in the standards. We are seeing the world come up and question what does ESG mean and what does it, really stand for. And you're seeing a lot of regulatory, regulations changing in India. We are going to get BRSR reporting at the end of this FY. India has committed in the latest COP26, which is a UNFCCC convention, where we're going to get a net zero target by 2070, and investments are going to get mobilized in this space as we go forward. Again, ESG is a very broad spectrum and a broad term, and what we are trying to really do as a part of really integrating it into our investment process, really enhancing it. So we have come up with an ESG investment framework, and through that we really want to evaluate companies above and beyond the financial metrics that have been traditionally used. So, and the main driving force behind our framework is going to be materiality, because we believe it is very, very important to link the realities with the the frameworks we are creating, because it's very easy to go on and on about different parameters which are there and create some benchmarks, some source cards, but it has to be linked to the realities, and that's the very, very important part of that whole process. And in the framework that we've come up, we are using both qualitative and quantitative parameters to evaluate each and every company. These are again specific to sectors and industries where we are looking at, because we realize that something like governance, which is the G of ESG, which is environment, social, and governance. Now the G part is maybe very, very crucial for something like a bank, but maybe environment and social may not be just as relevant, right? Like if I'm looking at a manufacturing company, the environment, the social aspects come into play more. So we are creating a customized framework which is going to be acting up for every particular sector, and it will give us a more holistic picture around how that company stands out, except just the financial metrics that we already look at, and help us compare better and make a more informed decision. So with that, we really think that this can really add long-term value when we select companies and look just beyond the financial metrics. Thank you.
Thanks. I think great introduction. I would just say that of all the things that Mehul does, one is forensics, one is ESG, the third is quant. Forensics for us is a 1-0 tool, in the sense if we are not convinced, we don't move forward. ESG is more as an information tool. It's basically something that we want to be aware of as to where the company is in the context of the sector. Maybe rate the companies in the context of the sector, which quintile or quartile they fall in, and engage with the companies on a proactive basis to see how that can improve. It's not a 1-0 tool for us at this point in time. At the moment, it's more an awareness tool. Of course, we would like to be in companies where there is a focus in that. But our ultimately focus is to make money for our investors. So just wanted to kind of flag that off as Mehul talked about that. Radhika?
Thanks, Trideep. So I've got a bunch of investor questions. We're going to try and take some of them, and then if we can't take all of them, then we'll try and take them at the end of the session. So Trideep, the first question is, and anyone can answer these, but this is a market-related question. What factors can cause a Nifty PE derating from the current juncture? And can the peak of the interest rate cycle, and of course there's been a lot of noise about this, cause a minor correction in equities?
Very interesting question. And allow me a couple of minutes to answer. So basically, one of the things that in my opinion is happening in equity markets, which is worth absorbing and understanding, is this interest rate regime change. Over the last 10-15 years, we have been used to a situation where basically China was the workhorse of the world. It used to export deflation to the rest of the world. And hence, we were in a deflationary scenario and interest rates were
Hi,
coming
can you
down.
hear me?
Starting somewhere around the end of last year, or maybe the beginning of this year, we have seen this change. And it has caused a bit of flutter in equity markets, certain components of equity markets which are maybe growth stocks more than that of others.
Okay, thank you.
But basically at the center of all of the epicenter of all of this is basically the interest rate regime change which is happening.
Okay.
So given that preamble, will the interest rate increase result in basically lowering
How's
of
that?
PE? The answer is yes. Over a period of time, when as
I
cash
can't
flows get
hear
discounted
you
at a
over the
slightly
noise of the
higher
person
rate,
speaking.
the valuations of that actually comes down. It's just how the mechanics work, and hence, kind of to that extent, we will see valuation P multiples done that. Now, some data for you. Since the beginning of this year, the P multiple of India has contracted already about 15%, and not just in India, but if you look at globally. So it's not that I'm kind of, propounding something which is completely out of the world. It's really happening as we speak. And it will probably continue to happen till the time the market finds its level of the right interest rates, in the sense where the Fed hike may be globally, or in the context of India, where the market gets an understanding that this is where the interest rate hike will probably stop. That'll probably settle the P derating process for good, and then we will start focusing on the earnings growth in that context. So yes, it is a bit of a, particularly for people who have been investors in the last decade, where what we have been used to is a scenario where PE expansion happens. I think over the next 2 to 3 years, you have to be mindful that the PEs might not expand. In fact, it might contract. And basically, we have to hang our hat on earnings upgrades. And that's what we plan to do.
Terrific. So I'm going to combine two questions into one, Pradeep. There's an advisor who wants to know a little bit more about the decision-making process as far as stock and sector selection in the team, and how as a combined research team plus fund management team we take decisions. There's also a related question because you talked about not taking skewed sectoral calls, and if that's not done, how do you generate alpha? So if I can combine these two questions.
One good thing about this question is, one thing is very clear. Whatever we have spoken here in the last 45 odd minutes has gone to the other side. It is not just, which is great. So thanks for that question. So, we lock ourselves up once a week, basically, to discuss elaborately on sector views as well as stock views. And basically what comes out view is not just my view or Abhishek's view or Sahil's view, but what we as an aggregate are collecting data points from various parts of the market, put that in the form of an investment sort of conclusion, and then take a view on the sector and whatnot. Now, the sector view, when I said that we don't take active sector bets, the range that we do so is basically plus minus 5 in the context of the index, which is some latitude, not a huge lot, but there is some latitude towards taking a bit of sectoral skew. My experience over the last 25 years suggests that generally macro and sector bets, the net alpha over a period of 3 years is 0. What really works is if you've got the stock call right or not. As Warren Buffett said, if you've got the facts right, as it turns out to be, then you will get rewarded for that particular stock rather than the sector. So that's how we take the sectoral view. What we also do very religiously is for all the stocks that we have, and we have about 125 to 130 in our portfolio, we have our estimate of what we call as intrinsic value. Now, what tends to happen is when we look at all of these in conjunction, we find that sometimes the upside in some particular sector is looking reasonably high, and on the other side, it's basically low. So that is a good tool for us to really think about that whether there is an investment upside in a particular sector versus that of B. Usually, these two combined, put together, have been good lead indicators towards basically making sectoral calls for us. But as I give this answer, I want you to note that the answer for the sector calls also ultimately is coming from a bottom-up view rather than taking a top-down view with regards to one sector or the other.
Thanks, Pradeep. And I think I will take the last question. It's an interesting question, but I thought I would address it. So there's a partner who wants to know a little bit more about our organizational structure and the fact that we're actually going to be having 4 conversations with 4 different teams today, and why is it structured that way? Because it's a little unique as an AMC. So I think what we do at Edelweiss Mutual Fund is we build centers of capability and very focused capability. And what you see today are 4 capabilities. There is a deep long-only capability that relies on a fair process and bottom-up stock picking that is represented by the team you see here and is led by Pradeep. There is a fixed income capability that is led by Dhaval, and he will talk more about that. There is a capability around hybrid funds, and of course Balanced Advantage Fund has been an extremely popular fund, and we do believe, by the way, that hybrid is a separate set of capabilities. The process is a lot more quantitatively driven. It has elements like special situations and arbitrage, as well as a blend of equity and fixed income. And finally, there is an international investing capability where we partner with some of the best fund managers in the world, and JP Morgan has been a fantastic partner, and you'll hear them in the next session. So what we do as a fund house is we find talented managers, we find talented teams, we build funds that are true to label, and we are very focused on capabilities. The other thing I would mention is that if you see each of these teams, they don't manage a monstrous number of funds. So the team here today manages about 5 funds. That number may be 6, it may be 7. It of course will grow over time. If you see the hybrid business, you'll see a similar number of funds. Fixed income is also very focused in what we want to do. So we want to be very, very focused in what we do, because ultimately, I think, as Trideep said, our responsibility is to make money and manage risk on your hard-earned money, running a fewer funds in each team and giving each capability sharp focus. Each of these funds go through an elaborate review process, that I'm also part of. So managing less, being very, very focused and building these areas of capability is extremely important to us. And that's how we built the business. And if there's another area of capability that we find, then we will do it. We also don't want to do things that we are not ready to do or that we are not experts at. So that is what we'll stay away from, which is why you've seen limited but hopefully impactful launches from us. So that's just a little color on the org structure. With that, we're actually out of time in this session. So I'm going to close this section. Thank Pradeep, Abhishek, Sahil, Mehul, and all of you for your questions. And now hand it over to our next session, which is on international investing. My colleague Niranjan Awasthi and our team from JP Morgan will be joining us for that.
Hi everyone, welcome to our next session on international funds. Now we'll be covering 2 very important funds, and we have seen a lot of questions around our Greater China Fund and US Tech Fund. To cover the first part, which is a Greater China Fund, we have Alex with us today from JP Morgan team. Welcome, Alex. How are you?
I'm great, thank you. I'm just feeling huge regret. I'm not with Darrington, but that day will come very soon.
Right. So let's going, Alex, and I'm sure the slides are up, and you will, answer as many questions a lot of our investors have today. To start with, past 1 year has been fairly volatile for Greater China region, and investors have seen a lot of volatility. Could you just share your views on what has been the key drivers behind this?
Okay, of course, I'd be very happy to. And let me thank everyone for your time today. It's hugely appreciated. So I think really the first thing we need to accept is that Chinese equities are a volatile asset class. And it's worth just setting that out up front, because we need to manage our expectations that this is not a low volatility investment opportunity. But what it is an opportunity where we think that over time that volatility will be more than offset by the gains we can make from it. Now, specifically to the last couple of years, let's go back almost exactly 2 years, which will be the left side of this chart. And COVID-19 emerged on the world. And of course, that resulted in a huge clampdown, not just in China, but in India and really in everywhere. And the way that the government responded to that was to conduct very substantial stimulus. Now, I would say that the stimulus out of China was actually more moderate than the stimulus we saw from some of the developed market central banks. But nevertheless, there was a major push on the monetary, on the fiscal side to get GDP up to recover from this. And a bit like many parties, then the next year, 2021, we had a bit of a hangover from this. So we saw a compounding of the economy slowing, and this was partly given the extremely high growth rate in the previous year. The government had accepted the slower growth rate in return for a more sustainable growth rate, and so they were squeezing certain sectors such as real estate, which is quite deliberate. And they also were worried about this a K-shaped recovery, which you will have heard about, which is to say that the rich get richer while the poor suffer. So asset owners were doing quite well out of appreciating equity values and asset prices, whereas people in the gig economy or informal labor were suffering at the same time. And China, a communist economy, was worrying about this. And so the regulatory environment also got more stringent. And behind all of that, of course, we've got ongoing geopolitical tension, which I'll be very happy to discuss. And this is sort of bubbling away in the background. So if we put all of that together, last year then was a more difficult year for Chinese equities, partly for reasons which China can't control, such as geopolitics, and partly for reasons which were very much within its control, which is to say tighter regulation and a squeezing of an over-leveraged real estate market. Well, that all then got compounded earlier this year when something beyond all of our control took place, which is to say the Russian invasion of Ukraine, which of course has been a dampener on growth and at the same time has pushed up commodity prices, particularly energy prices, which has been negative for margins. And so the question now is what happens next? And I think we will come on to answer that. But really, this is the ride we've all been through. These are the circumstances of the last couple of years, which, as you say, have been, they've been keeping us all busy, shall we say.
Thanks, Alex. And as you mentioned, it's been an eventful year for Chinese equities and a lot of regulatory changes. So how has the portfolio manager responded to these changes? How the portfolio is aligned or changed over the last couple of quarters? And can you take us through some of the interesting themes or stories in the portfolio currently?
Yeah, I would love to do that. Thank you. So I think the first thing to say is that a lot of what the regulator has been doing is maybe more logical than you would think from just reading newspaper headlines. And I would counsel you never to invest on the basis of newspaper headlines. And so the regulatory moves have been more logical, targeted, and consistent than some people give them credit for. So, for example, clamping down on monopolistic behavior from companies with very big market share, that's not something which is remotely unique to China or the Chinese regulator. We've already seen that in many Western markets. So we need to understand their motivation. The next thing comes around portfolio construction, risk control, which is to make sure that our capital or our clients' money is invested in the areas where we've got the most confidence over the outlook and understand the red lines that the regulator sets on social and political agendas versus some of the other things. But the other thing to say is that actually, at the same time as there are these challenges, there are also some substantial tailwinds in the Chinese equity market. And we lean into those, as the expression goes, to make sure that we're benefiting from the more positive elements of what's happening. By the way, you might not always read about them in the newspapers because, of course, newspapers don't like to print the positive news, but it does exist out there. So let's go on to the next slide, please, as an example of that. Now, geopolitical tension between the US and China will persist for a long time. And I say that with great certainty because we're going from a world which has been dominated really by one superpower to a world with more than one superpower. And that makes the existing superpower, the US, feel somewhat uncomfortable. And so they will keep pushing back at China as China gets wealthier and more powerful. Now, one of the ways that China is responding to that is to become self-sufficient in a variety of technologies and areas which previously they used to import. And semiconductors is one example of this. So if we go back 10 or 15 or 20 years, China was not a player in the semiconductor market. Now, not just as a function of demand, but more excitingly of innovation and patents and intellectual property, China is able to do things and to provide not just goods, but also related services, which simply weren't possible previously. So we've been adding to tech hardware around a variety of different areas. And this might be things like parts of the, to do with industrial automation. It might be some hardware which sits behind renewable energy, which is something we'll be talking about later. Over time, we've had exposure to components of smartphones, et cetera, et cetera. But there's just a wide range of tech which will actually benefit from geopolitics rather than suffering on the back of it. Now, another example of an area which has got a following wind, shall we say, is on the next slide. And this is solar power. Now, if we go back about 5 minutes and I said that China is accepting a slower growth rate, but in return for a more sustainable growth rate, there are various elements to that sustainability. One is, for example, balance sheet sustainability, which is why they've been more aggressive with the real estate sector. But another area of that sustainability is environmental sustainability. And China will accept less growth, but they want less pollution at the same time. And so solar power is a really good example of an area which we know is important for all of us, but also has got in essence, the backing of the Chinese government. And there are many different ways we can play this up and down the supply chain. So it can be in the solar power companies, in people who supply certain chemicals to solar power, certain components. And there is an array of different opportunities here. So we have Tongwei on this slide. And then I think for my final slide in this session, if we can go on to the next page, please. Another example is in EV, which is to say electric vehicles. And electric vehicles sit at the confluence of two very powerful forces. The first is what I've just mentioned, which is the government wants this to happen. But the second force is that, thank goodness, the younger cohort of Chinese consumers who are coming up through the ranks and who are in a position now to buy vehicles, they are also more concerned about their carbon footprint. And so China is already the world's largest market for electric vehicles. We know that Chinese people will buy more cars in the future than in the past as they become more prosperous. We know that people want to travel. We can also see that they want to buy less polluting vehicles with help from the government. And so here again, we look up and down supply chain, typically not buying the brand owners so much as buying people who supply the brand owners. For example, China's largest battery manufacturer for electric vehicles, which also supplies internationally. And CATL, it doesn't matter to them which brand gets the most market share, because if they're supplying to all of them, then they will be benefiting. A little bit, I think the expression is like shovels to miners. Doesn't matter who the miner is, as long as you're providing them the shovels, you will do well. So this is another area that we have been positioning towards.
Right. So very interesting stories, and I believe there's a lot of secular themes, and I'm hearing this for last 2-3 years, which means most of these are secular stories. What's happening on the economy around the world is not changing the underlying growth trajectory, or a lot of positive for these themes. So quite interesting, Alex. Thanks for sharing them. But my last question to you before we move on to audience question is what is the road ahead? Whatever bad news was there, is it an end to that, or what's your view, at least in the near term for?
Of course. Well, great question. And I think the first thing I'll point out is the point you made about these themes being unchanging. And that's an incredibly important point to raise. Because if you are a short-term investor, then I don't think this is the product for you. I'll be very, very open about this because I want to make sure that everyone's expectations are appropriate. We don't know what will happen next month, and we don't know what will happen next quarter. What we do have very high conviction in is that the Chinese economy in 5 years' time will be meaningfully bigger than it is now, that there'll be certain areas of the economy which have benefited as a result, and there'll be certain companies which will be providing to those areas. So by design, we take a longer term view because that's where we think we can add the most value and do the most thorough analysis. Now, having said that, what's the path we think over the next year or so? And if we can go to the next slide, please. There are lots of boxes on this page, or lots of, I don't know, lozenges. And really the path to focus on is the top one, please. So the Chinese government has come out in this politically sensitive year, and they have said they want a 5.5% growth rate. Now, the Chinese government, like many other governments, doesn't like to be wrong about these things. And so what we're quite confident on is that they will do what they can to get to that growth rate using whichever tools are available to them. One of the things which we don't think will happen is a mass easing of restrictions around COVID. And I've been speaking to my colleagues in Shanghai just this week, asking them how they are and what's going on there. And the strong consensus is that the zero COVID policy, whether you agree with it or not, is not going away. But if we accept that there is a zero COVID policy in place, and if we accept that China needs to achieve its 5% growth target, then the missing pieces are basically regulation, some degree of geopolitical easing, hopefully, and stimulus. So we don't have a huge amount of certainty over the path of COVID. We do know that the government wants a 5% growth rate, and so we can be pretty clear about what it takes to get from A to Z. And that's on the next chart, please. So what the government needs to do is to push on two things to stimulate. The first is to boost demand, and the second is to ease supply constraints. And if you put those things together, then the economy will be stronger as a result. So on the demand side, we've got things like fiscal stimulus. And as I mentioned earlier, China, although they stimulated in 2020, was more restrained than many Western governments. And so there is space there, and we'll talk about it a bit more on the next page. And we've also got monetary stimulus. And this is super interesting because although the RBI has been very cautious over the last year or so, more generally, the trend is for central banks to be raising interest rates, but not in China. China has been cutting rates, or they've been cutting their RRR rates since late last year. And we're seeing more generally an easing of some of the things they put in place last year while they're stepping on the brakes. And this can be things like the availability of mortgage financing, for example. And then on the bottom half of this page, in terms of easing supply constraints, well, this is where we think that the toughest days of the regulator are behind us. Now, that doesn't mean that regulation will go away altogether, because China has a lot of regulators and they regulate. That's their job. China is a centrally planned economy, and again, we need to accept that. But that doesn't mean that they're equally as tough all the time, and it doesn't mean they always focus on the same sectors. And so we think that they will take a more benign view on regulation. We've already seen some easing of computer game approvals, for example, in the cybersecurity space, because that is a controllable and necessary step towards getting the growth rate that they want. So we think you'll see fiscal stimulus, monetary stimulus, and regulatory easing. And I love the fact that this is counter-cyclical at the same time as so much of the rest of the world is looking to tighten. That's diversification 101. And then on to my final slide, please. If we just dig a little bit deeper into some of these concepts. Well, the fiscal stimulus you can see on the left is going to manifest itself in certain ways. I mentioned real estate earlier, but another important area is infrastructure. And as opposed to being the old-fashioned Chinese infrastructure, which is really big, heavy roads and bridges, we think more of that will be in smart, new economy infrastructure, making sure that the internet is world-beating, making sure that they've got the right logistics and that everything can be just on time. And then on the right-hand side, well, we've mentioned regulatory action. I think just a cessation of what's been happening there would be very positive. And in our portfolios, we've been concentrating our capital in stocks where we see the best upside from this point. And there's a food delivery company called Meituan, which would be an example. They have seen a little bit of action recently because the government is pushing back on the fees they charge to restaurants to deliver food at the same time as the pandemic is ongoing. But we do think that will ease in time, and then we can take a step back, look at their competitive position, their growth potential, and that's an example of a stock which we think has got real upside from here. So those are some of the things that we're doing in our portfolio.
Thanks, Alex. We have one very interesting question. The question is around China valuations. And if we compare China valuations with anywhere in the world, they're probably at a very discount to their maybe average or peers. So what is the reason for that? Of course, we have seen some volatility could be the reason. Your points on that, and how do you look at these valuations compared to the growth prospects? Do you have any numbers, maybe at the portfolio level or at the benchmark level, on the future estimated EPS growth on China market?
Okay, well, I'm not sure if you've got slides there that I put in the appendix too. There's a slide a couple of pages forward, which will, this is encouraging, which will show us what the expected return is like on our own proprietary measure. So let's go one more slide. Let's stay right there, please. You're in exactly the right place. So we have a proprietary measure of the 5-year expected return of the stocks that we look at. And the key drivers of those expected returns for our portfolio holdings in China are around the earnings growth rate over those 5 years and the exit multiple. And what you can see here is that 5-year expected return is really as high as it's ever been. To be clear, this is not a valuation measure. So for valuations, the higher they are, typically the more expensive they are. This is the opposite. This is the return we can expect from our companies. Now, the reason they're looking quite cheap is because China has been clamping down while a lot of the rest of the world has been more relaxed in this respect. And so it's acting in an idiosyncratic fashion. It's acting in a counter-cyclical fashion. The benefit of that is it means that I think they've set themselves in a better position for upside from here than maybe some other markets. And that's really not all in the price. The key for us is to be very, very clear about our earnings assumptions then. Because if we're wrong on the earnings, then we'll be wrong on the valuation as well. And around that, to give you a bit more color on some of what we've been doing, we've been taking down some of our consumer discretionary exposure recently because we can see the cost push inflation. And we know that there's a relatively soft demand environment just for the moment because of lockdowns and COVID. And so that means there's margin compression. But we've been redeploying that capital into areas like tech hardware, into solar, and to some other spaces like that. Maybe a few more financials, which are beneficiaries of some of what's going on here. So I think that the key as ever is to be very selective, to be very rigorous in your fundamental research, but also to be quite unemotional and to accept that we do see China in value in China, in a way that was less evident maybe a year or two ago.
Right. Thanks, Alex. Another interesting question is around the attribution. So while you explain what has hurt, which specific sectors have hurt the performance over the last 1 year in the China fund? And is the portfolio manager exiting or exited those names or those areas in the portfolio?
Sure. Okay, that is an interesting question. And the answer is that the attribution has come from a couple of areas. One thing is that as we see a risk-off environment and as we see US rates going up, inevitably we see valuation compression for long duration assets. So another way of saying that is you get companies who've got more of their value out far in the future. They will suffer relative to companies who've got a lot more visible value now. And this is what's driving this rotation from growth to value, not just in China, but across markets through Japan, through the US, through Europe, etc. And so that has been a detractor. So some of the stocks that we've held in technology or in healthcare have suffered on the back of that. We've also seen the regulation extend not just from e-commerce and other areas of internet to healthcare. And so that has also impacted some of the stocks that we hold. And then also it's not always, of course, what you hold which can hurt you, it's what you don't hold. And we are very clear that we want to stay away from some of the big state-owned banks in China. They've got low profitability, they're not particularly efficiently run. We are not top of their list of stakeholders. They are at risk of national service. But as we've seen rotation through markets, they have outperformed them because we didn't hold them. Then we have had some detraction as a result. As for what we do about that, the key is to go back, look at your numbers, take an unemotional view on valuation, and decide on your next steps. So for things like healthcare, where we've seen geopolitical tension and regulation both feed into the weakness, there we have consolidated our positions or our bets, in inverted commas, into the stocks where we think that the valuations are most attractive and we've got most conviction on the outcome. In solar, typically we've been adding, as mentioned, and so we're much more confident in that, at the same time as taking some money out of consumer stocks, some of the staples, but also some discretionary names where travel, for example, won't recover anytime soon in China. And we're also just revisiting our conviction on the banks. And if I speak to the PMs, they're not going to start buying low quality banks just because they've been outperforming. So we're not going to change our position there, but maybe at the margin, we'll have a little bit more money in sort of real estate sensitives or some stocks in that space, which we think will benefit from the easing. So we don't go back on our fundamental conviction. We just test our views and make sure that our capital is deployed in the areas where we've got the strongest conviction and the best risk return trade-off.
Thanks, Alex. And I won't let you go without asking this very, very important question, which we keep getting. So when we look at data, whether it is from Chinese companies or Chinese economy, how reliable these data points are. And you, because we have partnered with you, we are quite comfortable with JP Morgan team being there on ground. So can you just let us know how the JP Morgan team is structured and how do we go about researching the fundamentals about China and the stocks before we picking and creating a portfolio for our fund?
Of course, and it's a very reasonable question. Thank you. So the first thing to say is that the more we can do ourselves, the more comfortable we are. And so we have a very, very robust proprietary research team. We have 16 analysts based in Greater China, so either in Hong Kong or in Taipei or in Shanghai. Between them, they cover about 630 Greater China names, of which around 300 are A-shares, so in the onshore market. They all speak Mandarin. They can all read and write. When the borders are open or when things are more relaxed within China, they travel, they see companies. And the more that we can do ourselves, the more comfortable we are. Then, of course, we've got our portfolio managers, Howard and Rebecca, who are both still fluent, et cetera, based in Hong Kong. And they're working with those analysts to make sure that we've got the best possible portfolio construction. We have a very, very rigorous research framework in China. And what we don't believe is that somehow you should treat Chinese equities differently than, say, an equity in a different market. We look at the same fundamentals, we look at the quality of the business, we look at the risk profile, and we look at the expected return. So there are no special rules. But also, of course, what we need is just to make sure that, to your point on data, and where there is data which is unreliable, well, we will either discard it or take that into account and make sure that we're concentrating our firepower in the areas where we feel confidence. For example, some of the macro data might be a bit less reliable, but that's okay because we're not macro investors. Conversely, by going and visiting companies and using the disclosed data on their performance, we can be much more comfortable that it is indeed reliable, and that's where we put our clients' money. So it's really being aware of the pitfalls, making sure that you combine the best of a global and a local approach, having boots on the ground. We've also got our joint venture, I should mention, in Shanghai, CIFM, and then just being aware of the problem. So in the same way that China is a volatile market, but if you accept it, then you learn how to deal with it, then for sure some data is patchy, but that's not unique to China. And we focus on the areas where we do have confidence. If you speak Chinese, it's maybe not as bad as you think it is.
Thank you so much, Alex, for sparing time for us today. And thank you for all the answers that you have given here. It would definitely give a lot of comfort to our investors in this fund. Thank you so much. Have a great day.
Take care. Thank you.
Thank you. Hi all, we'll just quickly cover our next fund, which is the US Technology Fund and what's happening in the US. If you see over the last 1 year or beginning of this year specifically, we have seen a lot of volatility in US markets, especially in the tech stock. So what has contributed to the underperformance of the US tech fund is largely the small cap exposure which the fund has, and some of the technology names which have corrected, specifically the one which were trading at a higher valuation because the underlying growth was quite high. So two specific reasons for this volatility. One, of course, we have seen US Fed starting to rise rates. And usually when interest rates are rising, there is some bit of volatility in the growth stocks. The second is the perceived, the perception by investors that whenever interest rates hike, usually economy over the longer period of time may not do well. However, what should investors do? If you look at the data going back to maybe in last 2-3 decades, whenever there have been rate hike cycles in US, in fact, there have been 16 rate hike cycles, and on an average, they've been for around 18 months. During this period, S&P 500 has delivered on an average of 13 to 14% returns. Even recently, if you see 2013 to 2017 and 18 specifically, US saw a large rise of interest rates by the US Fed. And during that period, in fact, US markets, specifically the technology stocks, did extremely well compared to any other theme or any other region. So broadly, for US tech investors, we suggest them to stay invested. Of course, when the fund opens for investments, you can top it up and take benefit of the recent correction. How the portfolio is currently positioned for the US tech fund. Largely, the portfolio remains overweight on the semiconductor theme because we all know the structural tailwinds for semiconductor demand is in place. In fact, over the next few years, we'll see more and more demand for semiconductor. So the portfolio remains overweight on semiconductor. It remains overweight on internet businesses. We have seen digitization all over the world. The demand for internet-based businesses and companies all across the world and also in India is on rise. So it remains overweight on internet businesses. However, on the other side, it remains underweight. It has been subsequently underweight to some of the software and software services name because of heightened expectations from these companies. So broadly, this is how the portfolio is positioned. The underlying fund, again, is managed by JP Morgan team, who actively manages these team. The US Tech Fund specifically is a fund which rides on expected mega trends and the technology companies. So the team is divided across sectors, across themes, which pick fundamentally strong businesses through a pure bottom-up approach. And we believe that over the next few years, the prospect for US technology as a theme remains very, very strong for these investors and the fund. So thank you so much. In this section, we covered the China and the US Tech Fund, which has been two large funds for our investors who have invested over the last 2 years. And hopefully we have addressed most of your questions. If there are any questions, we'll take them up at the end of this session. We now move towards our next session on our hybrid funds. Thank you.
Good evening, everyone. Once again, welcome to our third session. I believe this is the most popular of them all in terms of the size of money that we manage. Before I start this session, I just wanted to highlight one important point about the hybrid team that we have, hybrid and solutions team that we have. It is very unique to the industry. There is a reason why we have chosen it to be different, because we do believe that there are different skill sets which are required to manage risk adjusted as a category. To kick off this session, we have with us our co-head for this team, Bharat Lahoti and Bhavesh Jain. Together they have almost 30 years of investing experience. They're also joined by their colleagues in the team who co-manages this entire space. I would first request Bhavesh and Bharat to introduce their team before we kick off the questions and get on with the session. Bhavesh?
Thanks, Deepak. Just to introduce our team, obviously Bhavesh has been there with Edelweiss for a long period of time. I've been also there since last 6 years in Edelweiss. We have been also associated with two of the bright minds in the market, if you look at it, and they are handling different set of pieces. We have Noor, who handles our quant piece, since we run asset allocation model, which is very important. We also run a lot of funds from a process-oriented approach to a quantitative space. So this is one of the space where he handles a lot of things. We have Ashish Sood, who handles a lot of fundamental activities, since a lot of our quant investments is driven by fundamental approach. So Ashish helps out in that context.
So let's get going with the questions, Bhavesh. The first one is a very basic question. What is the investment approach that you follow in the Balanced Advantage Fund? If you can just clarify it for our investors and people who may not have really invested so far.
Thanks, Deepak. See, in Balanced Advantage Fund, what we try to do is manage this money to give equity-like return with limited amount of volatility. You will see the fund invest almost 80% of its AUM into equity and 20% into debt. The 80% which is deployed in equity is managed dynamically, depending on our asset allocation model. So sometime our equity can go down to as low as 30%, and the maximum we can go is up to 80%. Remaining 20% always goes into debt, where we manage debt in a very simple approach. We have GSEC, we have T-bills, and we have short-term papers, but strictly AAA rated. As far as equity bucket is concerned, we deploy mostly into large cap names and strong companies with clear on corporate governance. So this is how our equity deployment is taking place. Now, coming to the important piece, which is the asset allocation model we follow, which internally is known as Edelweiss Equity Health Indicator. Here, we try to use a market trend, health of the trend, and basis that we decide how much equity we have to keep in on a daily basis. Now, broadly, if you will see in market, most of the Balanced Advantage Fund uses the most, you can say, common approach, which we all have heard of, that is known as valuation-based asset allocation model. We are slightly different. We follow a pro-cyclical approach. And then obviously, each you can say asset allocation model have their own advantages and disadvantages. But we have choose to use the pro-cyclical one and not the, you can say, the common one like counter-cyclical.
So interesting you mentioned about 30 to 80%. How has this asset allocation played out in recent times over last 1 year specifically, and maybe over last 3 years, if you want to highlight that, and how it has really helped the performance?
Sure. You will have seen markets have become more and more volatile in recent times. We started with US about to increase their interest rate. Then we saw our own union budget. We saw multiple state election. After that, we saw this one important event between Russia and Ukraine, which led to a lot of volatility, not only in our market, but globally also, and across asset classes. And obviously, with this amount of volatility, our asset allocation model also have gone under tremendous changes. You will see in October 21, we were running almost 70% equity. So it is the maximum we can go. We were almost at 70%. From 70, by beginning of March, we were at 35% equity. By end of March, we went up to 63, and today, as we speak, we are closer to 55. So a lot of changes have happened to this asset allocation in last 6 months. And similarly, if you will see for last 3 years also, we started with COVID, then lockdown and all that stuff, and we saw lower circuits into market. And after that, we saw a lot of stimulus by both, you can say, central banks as well as government promising that they will do whatever it takes to protect their economy. So all these things led to a decent run up in the market. But overall, now when we look at last 6 month performance or last 3 years performance, one thing which is clearly showing up that our nimble approach, or as far as our asset allocation model is concerned, has helped us to relatively outperform most of the peers in our category, and with a reasonable alpha of say close to 3 to 5% across time period. And most importantly, if you will see in last 1 year also, Nifty is up close to 20%. We have delivered around 14% return. But return is just one part of the story. You will see we have reduced volatility, we have reduced drawdown by almost 50 to 60%. And as far as returns are concerned, we are still delivering almost, you can say, returns in the range of 70 to 100% of what Nifty is delivering. So on a risk-adjusted basis, I think we have been able to deliver excellent amount of, you can say, excellent numbers, both in the shorter period of last 6 months to 1 year, as well as longer period of 3 years and 5 years.
Thanks, Bhavesh. You mentioned equity-like returns, so it's important to look at the underlying. And especially in the context that we live in today, where interest rates, after being so low for a very considerable period of time, are seeing some changes, etc. So in that context, how would you define the core philosophy that you follow for your long-only portfolio? And if you could throw some light on overweight positions or underweight positions.
Sure, Deepak. Obviously, equity investment is almost 80% of our AUM, and that is, you can say, the most important piece. Looking at the way environment has changed over last, or you can say 1 year or so, accordingly, we have also changed stance in our portfolio. Normally, we follow quality and growth at a reasonable price as an approach for our equity investment. But you will see in recent changes due to, you can say, the Russia-Ukraine issues, US Fed increasing rates, we have made small adjustment to our portfolio also. So in fact, you will see of late, we have started reducing some weight into IT sector. We have also, in current environment where global volatility is definitely going to increase, we think that focusing more on domestic play is going to help. And that's why we have increased exposure to capital goods, because we see a lot of, you can say, uptick in orders. Similarly, we are seeing, because of decent cash flows, many companies have been able to improve their balance sheet. In addition to that, if you'll see, government has also announced increasing capex in their recent budget. So all these things are good for increasing weight to capital goods. In addition to that, we are also overweight on selective metals name, because I think some of the metal stocks have decent advantage in given, you can say, demand supply situation. They will be able to deliver a much better number. So we have slightly increased our weight over there also. Now, as far as our fixed income investment is concerned, as we all are expecting interest rates to go up, looking at inflation number, we have decided to keep low to medium duration and strictly AAA rated papers in our portfolio.
Let me just throw the last question before I move on to Bharat. You mentioned about the model being different. If you could throw some more light on how the model is different and perhaps why you chose this model and for how long you have been running this.
I think this is one of the most important question, and I think we should get greater clarity on this to the larger audience. Most of the balanced advantage fund in industry uses different asset allocation model, but broadly you can divide them into two. One is a pro-cyclical approach. In simple term, it is known as trend-based hedging, which is followed by Edelweiss. And second is a counter-cyclical approach, or in layman term, you can say valuation-based asset allocation model, which is used by most of the players in the industry. So you would have heard words like price to earning, price to book, dividend yield, yield gap analysis. Different, you can say, funds use different terminology, but in simple term, that is nothing but valuation-based hedging. Now, each model have their own advantage and have their own disadvantages. There is no model which will work across market cycle. So normally what we have seen over last, you can say, 5 years of our live experience, all the models which follows valuation-based approach, they normally tends to outperform in the range-bound market. Like you will see in last 8 odd months, Nifty is hovering around 17,000 to 17,500 range. So valuation-based model will definitely do better in this kind of environment. But at the same time, if you will see India as a market, it is an high beta market, and if you will see historically, most of the times our markets are trending. And when we say trending, it can be bullish trend or it can be bearish trend. So whenever markets will be trending, a trend-based hedging approach which we use will tend to outperform a valuation-based approach. Same thing is visible in last 5 years also. If you will see, Deepak, in last 5 years, we have seen 3 years where markets were bullish trending. So 2017, Nifty was up almost, you can say 20% plus. Then 2020, Nifty was again up 15%. 2021, Nifty was again up close to 24%. And that's why, because most of the time markets were trending, our equity exposure was relatively higher compared to our peers, and that is visible in performance also. So we have outperformed most of the players in the category on an average by 3 to 5%, purely because of our asset allocation model. Again, this number is not limited to last 5 years. If you take data for last 10 years, last 15 years, last 20 years, picture doesn't change. 75% of the time, that is 3 out of every 4 years, markets have remained trending and suitable to our investment style or our asset allocation style. And less than 25% of the time, that means 1 out of 4 years, markets have been non-trending. When I say non-trending, that means markets are in the range of, you can say, plus or minus 5%, plus or minus 7%, or in simple term, are giving you single-digit return. So you take data for last 5 years, you take data for last 20 years, I think the ratio remains more or less same. And as a result, over a long period of time, I think our asset allocation model have that, you can say, advantage, inbuilt advantage of at least, say, close to 3% to 4% alpha on a CAGR basis compared to other valuation-based model.
Thanks a lot, Bhavesh. The passion is clearly visible. Let me come back to you with audience questions. But let's start talking to Bharat. Bharat Lahoti manages our Edelweiss recently listed IPO fund. Just to give some context about this fund was launched 4.5 years ago. Again, when there was a huge IPO frenzy, to provide a solution-based approach towards investing in IPOs or companies which are coming for listing afresh. I'll ask Bharat about it to give us more context and what kind of a problem that this fund really solves. But Bharat, what a journey. 2-3 bull and bear cycles already seen. How would you really describe this experience?
To just give you some sense about it, how actually IPO market behaves, IPO market works also in cycles. So if you look at it, we had a good 2017 year kind of stuff when IPO markets were again booming. 18-19 was a bit bearish phase in context of it, and consequently again we have seen IPO markets picking up in 2021. Now if you look at 2021, it was one of the biggest eventful year for IPOs, both Indian context and domestic markets, and globally also. So second thing which is important, it's not only about the number of IPOs which has came in, it is also about the amount of money which has been raised during this IPO. It's been multi-year high kind of stuff. If you look at just in Indian context, 63 IPOs came for listing, and finally around 1.2 lakh crores of money was raised during that. And if you look at, there was an average listing gain of around 21% for IPOs. So this has been extremely eventful year from IPO perspective. Just to give you a few more context about it, why this year was also interesting from it, you would see at least 40% of money which was actually raised actually was for primary issuance. Now when you compare it with historical context, over last couple of years it was 20% amount. So this money is broadly actually for growth capital, for strengthening the balance sheet of companies. So that is one important thing. Second interesting data point is that even after listing, there has been average listing gain of 15% for next 6 months in IPO stocks. So that is also interesting fact which people think about it. The third important thing, which is contrary to popular belief, that the IPOs is all about internet companies. But if you look at the number of companies which have come for IPOs, the sectoral diversification, it has been pretty much bare. We had 9 companies coming in the BFSI space, 8 companies coming in chemical space, 7 companies coming in the pharma and healthcare space, 6 companies coming in autos, and 6 companies in retail. So it's been fairly diversified. The internet companies, if you look at it, has been only 8 out of 63. So it's barely that kind of stuff. So that is how the IPO markets have behaved over last year, if to that context.
So the recent nervousness, what would you attribute it to, and would you really look at it from a short-term or a long-term perspective, from an investing perspective?
Okay, so as we move towards the FY22, obviously there has been cautious optimism in IPO market. Given the backdrop, what happened in the macro environment, Bhavesh has alluded some of the facts, and Trideep in his previous commentary has also alluded how the macro environment has dramatically changed over last 6 months. Given that most of the IPO market is always correlated to what happens in the equity market, there has been some implication on the IPO market. But having said so, over last couple of months, if you look at it, market have started stabilizing, and we would see IPO market again rebounding. That is one part of it. Second part of it, if you look at it in historical context, on an average, you always see like 20 to 25 IPOs coming in a year. If you go by calendar year 22, we already have seen 6 IPOs already there. Couple of IPOs may be lined up for next week, and maybe few more in next month. So broadly, we are pretty much on the track. If you look at the pipeline of IPOs in terms of the DRHP being filed out, there has been 100 plus DRHP been filed out across sectors. And if you look at it, they are at a various stage of approvals and discussion which are going on. So it's a pretty much tight IPO season, which I think could be happening for FY20, calendar year 22 as well, kind of stuff. If you look at the discussion which is happening between the investors and the companies who are going to come for IPO, most of the people have actually rationalized their expectations, both investors and companies. Consequently, you would see actually more reasonable pricing happening for IPOs going forward. Also, with the regulation changes in the IPO, which the SEBI has brought in with the respect to the allocation for HNIs, higher investment time limit for anchor allocation on IPO funding, a lot of sanity was going to prevail in IPO market going forward.
Thanks, Bharat. What has really helped the performance of the IPO fund recently, and what are the major changes that you have made over the last 1 year in the portfolio?
So the approach has broadly remained same for the way we have managed IPO fund for last 4.5 years, kind of stuff. Nothing has dramatically changed to that extent. The 5 basic principles what we have followed in this IPO fund has remained the way it is. First is a systematic way of investment. When we say systematic, it's a process-oriented way. Now, if you look at it, most of the IPOs would be mid-cap and small-cap, but we have categorically kept it a more multi-capish in nature. So we have actually a mix of large cap, mid cap, small cap in our portfolio. Second important thing which we have done for the portfolio perspective is that we have actually broken down the IPO universe into 3 different buckets, which is secular ideas, cyclical ideas, and avoid ideas. And our focus always lies to have a higher weightage to the secular growth ideas. If you look at it, the current portfolio, almost more than 75% of ideas are in secular bets. So those are 2 things which we have done in terms of process-oriented investment. Second important thing which we do in terms of principle is that we have to be extremely selective. So if you look at it, last year 63 IPO came in, we actually participated only in 24. So extremely selectiveness has helped this fund. The third important fact is that we think about long-term, about how the company is going to behave in long term and not just on listing day perspective. So if you look at our average holding period for this fund has been more than 2 years. And finally, if you look at it, there are 2 more basic principles which we are talking about is about sectoral diversification. One has to be extremely conscious about it. How do you diversify your portfolios? And if you look at it, our portfolio is well diversified across various segments. If you look at it, BFSI, retail, consumer, technology, I'm just saying it's been well diversified. And finally, if you look at the 5th principle which we are following is that don't buy everything on the day of IPO. You can buy gradually over time. So we build position gradually as and when the company announces results and so on and so forth. So that's how been the principle and which has worked well for this fund over last 1 year.
So Bharat, you already answered my next question with regards to sectors and businesses, but if in particular, if you wanted to highlight something which you see that may change over the next 12 months from a sector or business perspective.
Okay, so let me give you some sense about it, how actually we think about sectors and why this is very important. If you look at though we have well diversified sectors within our portfolio, but the theme what we actually work around is very different from the regular flexi cap funds. So you would see actually within the BFSI, we have not only private banks, we have AMCs, wealth management house, we have platform-based companies, we have insurance companies. Even in the case of retail, we have groceries, footwear. We have a lot of other stuff in that category. So we have a well-diversified theme to play around within that basket.
Thank you so much, Bharat. Right on the queue. We'll take a few audience questions. Bhavesh, let me come back to you. There is a perception or belief among a set of investors and advisors that Edelweiss Balanced Advantage Fund, since it follows a different model, is more risky than others. How do you really answer that question?
I think again, one very important question, and I'll say not question, but one of the biggest myth which need to be, you can say, busted. And obviously we will bust this myth with a lot of data we have. You will see in last 5 years, majority of the time, equity has outperformed debt. You take 2017, 2019, 2020, and 2021. That means 4 out of last 5 years, equity did better than debt. And the basic approach of any asset allocation model is to have higher weightage to asset class which will outperform. Now obviously 80% of the time equity has delivered better return than debt. So by default we should have higher allocation to equity. But having higher allocation to equity not necessarily means that we are more aggressive or we are more risky. I think the only time, you can say fortunately or unfortunately, in last 5 years, which all the balanced advantage fund got to showcase their real talent of protecting downside was in February, March 2020. Because I think in last 5 years or in fact in last 10 years, that was the only bear market which we all have witnessed. Now in that period, if you will see from top of 12,400 to bottom of 7,600, Nifty corrected by almost 39%. And in that fall, Edelweiss Balanced Advantage Fund, which people normally think is aggressive or high risky, because in January 2020, we were running 70% equity. But when you will see the actual number, Nifty corrected by almost 39%, we were down only 14.8%. Now, in the same period, if you will take some of the, I'll not take the name, but some of the larger Balanced Advantage Fund, or you can say the oldest one in the industry, all of them were down anywhere between 25 to 27%. So I think the data is visible. The other way to look at risk is you look at standard deviation, you look at drawdown, you look at say Sharpe ratio, you look at beta of the portfolio. In all parameter across time period, Edelweiss will be amongst, you can say, top quartile as far as risk is concerned. And obviously returns we have already discussed. You will find us on the top quartile on the return chart also. So obviously this is a myth, and I think we will be more than happy to share more data as and when demanded by audience that we are not the riskier balanced advantage fund. In fact, we are one of the most conservative and to that extent you can say least volatile balanced advantage fund.
So let me just use the marketing tagline, Badhat bhi or Bachat bhi. So thank you, Bhavesh. Bharat, I just wanted to ask this question. I had to ask this question. On 1st of February, Edelweiss restricted inflows into the IPO fund, which was removed on 1st of April. What really made you change, take both the decisions? First was restricting the flows, and then now allowing the flows above 1 lakh per day that you put.
So two things, obviously, if you look at it, one of the important thing is that market volatility was pretty high. And if you look at it, the IPO market was going through a troubled time. Globally, I'm just saying not in Indian context, but globally, if you look at it. So as and when we saw that market volatility is pretty high, we thought let's look at the fund more deeply. Secondly is about the liquidity. We always spoke about it. This fund is a limited opportunity fund, given that fact that the free float of many of the IPO stocks is very limited. Consequently, we have to keep an extreme eye on the liquidity of the fund. So we thought in this kind of volatile market, we need to keep two things in mind. One is the liquidity of the fund, and the second is how do you manage the volatility over the period of time. So that's the reason in January 2022, we actually stopped lump sum investment to that extent, and we actually did only 1 lakh kind of investment allowed per day kind of stuff. as soon as March came in, a lot of the volatility had actually subsided, and consequently we re-looked at this fund, given now the new liquidity profile, and given the pipeline of IPOs which I spoke about in my previous comment, we think opportunities are pretty much high from that context, and consequently we opened up the fund from that perspective.
So thanks a lot. It was really a bold call to take when you were receiving flows to the tune of 150 crores a month, and now reopening at an appropriate time for investors. Bhavesh, one last question for you, maybe a couple of them. One is with regards to comparisons that are drawn between dynamic managed balanced advantage fund versus the static aggressive hybrid fund. How would you like to position it within the team, and how do you see it as a tool of investment?
Sure. So you will see our team manage hybrid funds starting from pure arbitrage. So other than that, we also have equity saving fund, balanced advantage fund, and aggressive hybrid fund. Now, between you can say balanced advantage fund and aggressive hybrid fund, maybe after 3 year, 5 year, both of them will deliver similar return. But as I told you, the volatility is something which has to be taken care of. And that's why balanced advantage fund have its own importance. And aggressive hybrid fund is suitable to those set of investors who are ready to take or who are ready to digest this kind of volatility. For us, I think both the funds are suitable to different sets of investors. Earlier, people used to say that balanced advantage fund is purely tactical in nature, but now we have ample data to showcase that a balanced advantage fund is no longer a tactical play, but becomes a core part of your portfolio. I think aggressive hybrid fund over a period of time, you will see start replacing large cap allocation in some of your clients' portfolio. Because it has been observed, if you see data for last 5 years, last 7 years, last 10 years, return of aggressive hybrid fund and return of large cap fund or more or less is same. But large cap fund have slightly higher volatility compared to your aggressive hybrid fund. So I think there will be, as it becomes more and more difficult to generate alpha in large cap space, I think aggressive hybrid is there to capture that space with lower amount of volatility.
Questions are flowing in. I have only time for 2 more perhaps. One question is on the arbitrage fund. The question is perhaps, can this be treated as some kind of emergency corpus fund? How would you like to explain or really throw light on this kind of a positioning?
So Deepak, normally you will see people tend to keep at least 5 to 10% of their portfolio into liquid fund or short-term FDs or maybe some very liquid instrument purely to meet any contingency. Now, earlier people were not aware of arbitrage fund, but now the category is almost 1 lakh crore plus, and it has shown time and again that this is one of the most tax efficient way to park your short-term liquidity. You get better return, and in fact, it is not only return, on the other hand, you reduce your risk substantially. Even the safest fixed income product is, say, for example, liquid fund. You have entire 100 rupees exposed to short-term papers. So there is all kind of risk associated with that, even on that 100% of, you can say, relatively safer instruments. As far as arbitrage is concerned, almost 75% of your 70 to 75% of your portfolio is into cash future arbitrage, where there is zero counterparty risk, zero credit risk. Almost 20 to 25% is in T-bills and GSEC for your margin requirement. And risk, or you can say counterparty risk or credit risk, is limited to only 5 to 7% of your portfolio, which you put in short-term papers. And obviously, because of taxation advantage, because arbitrage being an equity fund, that advantage is always with you. So I think it is good to park all investment which have visibility of at least 1 month because arbitrage fund have an exit load of up to 30 days. So any liquidity which you have for more than 30 days and maybe up to as high as 1 year, a couple of years also can be parked into arbitrage fund.
Thanks a lot, gentlemen. Let me just answer this question, which has come up many a times during today's discussion. Whether a balanced advantage fund can be treated as a good substitute for a retirement or an annuity product. I think it's a brilliant idea. Gone are the days where you used to work for 40, 45 years, and then the retirement period was only 15, 20. We are living longer. Data suggests that countries, not just in Japan or rest of the world, even in India, when we started during the time of independence, our average living age was 52, it has moved to 70, and data suggests that it will go upwards only. So you are living longer and you're working shorter. So it's important that returns that you generate from your retirement corpus are higher, and fixed income perhaps can't solve that problem alone. So you need that additional kicker of equity, where at the same time you do not want the volatility to kick in at the same force. So as Bhavesh pointed out, that balance advantage funds as a category really can solve that problem from a risk adjusted perspective. So thank you everyone for sending in your questions. For the paucity of time, I have not been able to take all those questions, but we will try and reach out to all of you in any which way we can. Thank you so much. Welcome back. This is our most important session. That's why we have kept it in the last. Important for a variety of reasons. Out of the 82,000 crore that Edelweiss Mutual Fund currently manages, more than 55,000 crore is fixed income assets. out of which 52,000 crore is target maturity. So that's something that we really take pride in. And to talk more about it, I'm really happy to and thrilled to be joined by our fixed income CIO, Dhaval Dalal. Dhaval has spent more than 25 years in the bond markets. There is a reason why we keep calling him Bond. So over to you, Dhaval. Before you start the session, I would request you to introduce your team, and then we can get going with the session.
Thanks, Deepak, for that kind introduction. Let me start with introduction of Pranavi, who is on my left side. Pranavi joined us in 2017 from CRISIL. She joined us as a credit analyst, and she has handled the credit portfolio of our fixed income fund in a fantastic manner. And now I think she has graduated to managing and being co-fund manager of Edelweiss liquid fund as well as Edelweiss money market fund as well, right? And when she's not managing money or managing credit, she is managing her family. She is avid traveler and a reader. On my right side, we have Rahul, who used to manage the liquid fund and money market fund before Pranavi. And he has developed a fantastic track record for our investors in liquid fund and money market fund, being consistently quartile one. And now he is managing all our duration funds along with me.
So thanks a lot. Welcome, everyone. Hoping to have a great session today. So Dhawal, before I get into specifics of products and all, since you are here, I would like to ask this question. Bond markets are heading towards one of the most interesting times. Difficult or not so difficult, only time will tell. Rising inflation, tight monetary policy, rising yields, global scenario playing out differently versus the domestic scenario. How would you really advise investors to play this market or navigate this market rather?
Well, Deepak, that's a fantastic question. And, let me just step back to pre-COVID. I think the onset of the pandemic has actually created a completely different investment environment for us, right? Because since March 2020, the global central banks have pumped so much of liquidity and have reduced rates dramatically in order to get the economy back on track. I think in our case, India's economic growth collapsed by about 7.3% because of the pandemic. And now in the last 2 years, while the economic growth worldwide as well as in India is now coming back online, the important thing to note is that because of the kind of money that has been pumped into the economy, now there is a serious issue of inflation, which is coming up in front of all central banks. Now, central banks brushed aside the issue of inflation, calling it sort of like a supply side or transitory. But now I think because of number of factors, including people quitting the job market, or because of the geopolitical reason, because of something other factors, the inflation has becoming a little bit more sticky than what central banks would probably be comfortable with. Like for example, in case of India, since March 20, the average inflation has remained above 6%. That's the RBI's upper band of 6%, right? So it's been remaining above 6%. So far, the RBI has focused on getting India's economic growth back on track. But now, as the economic growth is coming back on track, now RBI is forced to look at the inflation number, which is not only becoming, which basically offer them much better tax-adjusted return.
So Dhawal, this is really very interesting. Before I move on to the second question, there's a follow-up question on what you just mentioned.
Which used to be the feeding ground for all our Bharat Bond ETF has not been there. And that, as a result of that, now we have to focus more and more on the secondary market. But we are dealing with this challenge very gracefully.
Thanks. Rahul raised an interesting point in terms of OTC market versus screen-based trading. If you could elaborate the difference between equity passives and debt passive and the challenges that a debt passive manager faces, Dhawal, it will be really helpful for all of us.
Well, you are opening Pandora's box right now, but in the interest of time, let me just say that for equity passives, they have to execute their trades directly on the screen, right? While in case of bond passives, Rahul and our fixed income dealer Hetul will really have to source assets from the secondary market by calling counterparties or calling brokers and waiting for the right type of assets to be available in the right quantity in a right yield. Because just because it's passive, that does not necessarily mean that we can buy any asset at any price, just because it's part of the index. To that extent, it is very important and very challenging, and I must commend that Rahul has done a fantastic job in applying his mind to find out which is the right asset at the right price. Because if tomorrow, if there are inflows in the fund and you just have to keep buying the same asset again and again at any price, it doesn't work for investors. So to that extent, it's a very, very challenging environment. But I'm very, very happy that Rahul and our dealer Hetul have done fantastic job.
So managing passive is not necessarily passive. Dhaval, Rahul mentioned about net inflows into this category. This category now is 80,000 crore plus, which essentially means large sets of investors have really welcomed the addition of this category. I know this is a very favorite question of yours, so let me just ask this question. How do you think your target maturity funds can be used by retail investors properly?
So, Deepak, I think the Indian mentality, I think the target maturity bond ETF and index funds basically appeal to the Indian mentality, which is kitna deti hai, right? So I think the retail and HNI investors, which used to traditionally be invested directly in the corporate fixed deposits or bank fixed deposits or any other instrument where they knew exactly what kind of coupon they'll get again and again. So versus the actively managed fixed income funds, where you have uncertainty of returns regardless of the time period that you are remaining invested. So the target maturity bond ETF and index funds have actually resolved a very big question that investors had in their mind. And because of that and other simplicity and lower cost, that investors have really embraced the target maturity bond ETF and index funds since last 2 years. As you have just recently mentioned that we have 80,000 crore worth of total AUM, I believe that we are just barely scratching the surface. If you look at India's deposit base in the banking system, it's almost about 160 trillion rupees, right? So I am extremely bullish on the future growth of target maturity bond ETF and index funds. I believe that we are going to be at least 2 to 3 trillion rupees of this AUM in the next 2 years.
So, Dhaval, before I get Pranavi in, I am tempted to ask a follow-up question on this again. How do you really differentiate between some of the products that are already available in the industry in the form of roll-down funds? I mean, either of you can answer. And target maturity fund. What really target maturity fund does, which perhaps a roll-down cannot?
See, I think the most important differentiating factor in my view is the SID. Or the document.
Offer document.
Offer document, where I think this differentiates a roll-down strategy versus a target maturity bond ETF. Because in a roll-down strategy, the SID of that fund, basically it's a do-all kind of fund, but it has been reconstructed to do certain things based on the desire by a fund manager. But at the same time, in the target maturity bond ETF and index fund, the investment objective is ironclad. You cannot do anything else. So that is one of the biggest differentiating factor, because tomorrow today a fund manager is doing something like this. If tomorrow he can technically do something else, which nobody can stop it from. While in target maturity bond ETF and index funds, because of SEBI regulation, because of the investment objective being ironclad, there is zero chance of getting anything else other than what is the investment objective saying.
So transparency, low cost, efficiency, so on and so forth.
Absolutely.
Let me get Pranavi into this discussion now. Pranavi, 2017, what a time to enter from CRISIL to Edelweiss fixed income team. So what's your assessment on credit environment as we operate now? And how are the portfolio tilted currently in the times of the credit and duration exposure?
Yeah, I think your first line itself was, inclined towards telling me that it was a tough environment from 2017 till date. And yes, India's credit cycle did come under pressure after IL&FS defaulted in 2018. After that, we have seen a number of defaults and downgrades, and trust me, as a credit analyst, I knew that it spooked not just the investors, but even the policy makers. This led to a widening of spreads between AAA to A-rated credits. And as all investors, they rushed towards safety. Everyone was trying to figure out what is exactly happening. As Edelweiss AMC, I think for us to gain investors' trust, we took an immediate call to do only mostly AAA rated assets to ensure that we are giving the comfort to the investors that they sought at that time. Currently also, we believe that, we will continue to do mostly sovereign and AAA in major of our portfolio. However, there has been a lot of positive development over the last 2 years. We have seen a lot of regulatory changes that have happened. Compliances has increased. Owing to this, the investment processes have become more robust. And I think that should just give additional comfort to the investors going forward.
Thanks a lot,
In terms of duration, I think we are, we have reduced the duration of our funds in line with our expectation that RBI may hike policy rates.
Thanks a lot, Pranavi. Dhaval, let me just again bring you in with regards to performance of our products, especially on the target maturity side. I'm talking about last financial year. Beginning of, or at the end of the last financial year, 2020 and 21, we saw some bit of rate hike threat and all, lot of volatility in March 2021. And yet we found that target maturity bucket 1 year down the lane did pretty well. What exactly worked and what did not work for others?
See, Deepak, one of the things which is, apart from being very shrewd, one of the things which I firmly believe you need is a luck, right? So as a fund manager, what we saw was that, as I alluded to the fact that while the bond yields October onwards started trending higher, as I alluded to the fact that the supply of primary assets on the long end virtually dried up. And that resulted in a significant tightening of credit spreads between AAA, CPSE and government bonds. And that provided incremental return to the clients and helped us beat even the sovereign fund of the same maturity.
Dhaval, there's a question on laddering. When we launched our Bharat Bond ETF in 2019, we advocated laddering to investors. This is still a very new concept to the Indian masses. If you could take some time to explain this, how laddering can be helpful to investors.
I think, Deepak, the laddering is a very, very important concept. Although I must admit that the time of laddering hasn't come yet, because the laddering normally works efficiently when the curve is relatively flat. What we have right now is a very, very steep yield curve, and as I mentioned to you earlier, that it's very rewarding to the client. Now, what happens is that right now in a steeper yield curve, a client decides to invest either in a 5-year point or a 10-year point, and he can see the difference in the yield and decide whether he is happy to take that additional yield by increasing the duration. But when the yield curve becomes very, very flat, right, and at that point of time, he is investing for longer period, but doesn't getting rewarded for increasing the duration. At that point of time, the concept of laddering will become very, very important. So what happens in laddering is that rather than investing in one point, he or investor decides to invest equal amount of money on all points, say starting from 1 year, 1, 2, 3, 4, 5, or maybe 5, 6, 7, 8, 9, or any other point that they feel are providing them with the solution of the problem that they are seeking. And in that situation, what happens that every time when the one maturity happens, the money is rolled over to the next one. And that way, the money remains invested in perpetuity, but at the same time, it handles the reinvestment risk of that maturity very, very well. So going forward, when the curve becomes steeper, there are certain portion of the ladder that will make money, certain portion will lose money, but by and large, in our experience, what happens is that the average maturity of the portfolio that the client has of the ladder remains pretty much stable. Volatility is extremely low. And as a result of that, we believe that the laddered portfolio generates much better risk-adjusted return than a normal open-ended solution.
So, Dhaval, last questions before we open up for all kinds of questions on all our sessions. We currently have 9 target maturity products, and you mentioned that the yield curve is steep. Which are the maturity segments that you would recommend to investors who are looking to invest, say perhaps from a 3 to 5 year perspective?
See, because of the steepness of the yield curve, my preferred tenure range is between 5 year to 10 year. Given the current yield of 7.3% on the longer dated Bharat bond ETF, and assuming that the average inflation in India remains close to 4.5%, these funds will have a potential to generate far superior risk-adjusted, tax-adjusted returns than even a tax-free bond. So if an investor has a long-term fixed income solution and a surplus capital to invest for longer period, they should prefer to invest on the 10-year portion. At some point of time, we believe that when the yield RBI starts hiking rate, at some point of time, even we'll probably offer even longer solutions.
So that was the next question which an investor had, that would a 25-year or a 15-year target maturity will become a reality? So you already answered that question. So basically you are suggesting 2027 to 2032 maturity for investors who are looking to invest between 3 to 5 years.
Absolutely.
Thank you, Dhaval, for being as candid and as passionate as ever. We come to a conclusion of our fixed income session. We'll again invite our speakers from previous session and our CEO Radhika Gupta to take final few questions and wind up the session today. Thank you.
Thank you.
Hi everyone. Here we are in the final session where we'll take couple of questions from the audience for our entire team. The session was supposed to be moderated by Deepak, but Deepak had some emergency and he had to leave. So here I am, Niranjan, taking the final session. So the first question is for you, Radhika. The question is, in our international funds, we continue to take SIPs and STPs. So are we investing this or are we holding cash? So the question is really how we are utilizing these inflows and making sure that there's no enough cash in the portfolios.
Absolutely. So as everyone knows, on 1st of February, because of industry-wide exceeding of RBI limits, we had to stop taking flows in international funds. But in line with SEBI and AMFI's guidelines, we are allowed to take flows in SIPs, existing SIPs. Now, in any of our international funds, whether it is US or China, you get inflows by way of SIP, which we are taking, and you also get a small amount of redemptions. In our experience, the inflows and outflows generally offset to an amount where we actually don't hold much cash. The portfolios are allowed to hold up till 5% cash, but we monitor this very closely and investors will be happy to know that the net cash levels we are holding in any of the funds is not even in excess of 1%. So the reason we are taking SIPs is we don't want to be disruptive to the large number of investors. And I know in especially US and China, there are a large number of investors who have signed up for SIPs. It's part of their asset allocation. So we thought this was an investor-friendly move. We offset it against redemptions. And as I said, the cash levels in the portfolio are quite moderate.
Thanks, Radhika. The next question is for you, Bharat. The question is, IPO fund, Edelweiss recently listed IPO fund has seen quite a bit of volatility over the last 6 months. So the reasons for the same, and what's your outlook on the fund? While you did cover the current positioning, but the recent volatility, if you can throw some light on that.
Just to give you some backdrop, obviously this is volatility which has come in the IPO market is not primarily induced in Indian markets only. It's more to do with global markets. If you look at the global IPO funds which have been running and the ETFs which are running around the IPO theme, you would see actually the drawdown has been pretty sharp, maybe closer to 35 to 40% kind of stuff. Here the drawdown has been pretty much limited to close to around 20-22%. If you look at the recovery which has happened over last 2 months, and actually that's what the best part of this fund is all about, that since we are invested in good set of companies, they rebound very quickly. And we have seen this historical trend happening earlier also when we run this fund in 2018, 2020, the same thing happened. As the recovery starts happening, and actually the recovery is pretty small, fast and swift to that extent. If you look at last 2 months of data, we have actually recovered close to around 8-9% in this fund. And we think as the mid cap and small cap actually take more momentum on it, we think the performance would improve from here on.
Thanks. The next question is for you, Trideep. In your large and mid cap and flexi cap fund, because they are very flexible in their mandate to invest in across large, mid and small, how do you manage the allocation between these three segments?
I think it's a it's a great question. So to a certain extent, the recent regulation by SEBI mandates to a certain extent, particularly in large and mid, the percentage allocation to mid and small cap, which is about 35% odd. But that's more defined by the regulation. But flexi cap as a category is unique in that sense that it can capture the mispricing across the market cap ranges overall. And hence, to take an excuse of this question to sort of talk about how we are thinking about the various funds that we have in the long only roster, I would say that while for investors who have long-term horizon, let's say 5 years and above, clearly when from an alpha generation standpoint, we would be kind of gung-ho on mid-cap fund as one of the clear opportunities to sort of create wealth over time. Whereas for investors who are looking for more risk-adjusted kind of returns, who are looking at 1 to 3 year time horizon, whether it is large and mid-cap or flexi-cap, those two are the bucket that one could choose from. And within that bucket, of course, flexi-cap is a more broader has a more broader range roster to choose from, and large and mid would be a slightly constrained version. But nevertheless, the track record of all of these funds over a meaningfully long period of time are in the top 2 quartiles. So from that perspective, whichever way it is, we have done a reasonable job at it so far. Hope to continue.
Absolutely, Trideep. Thanks. Bhavesh, the question is for you now. Balanced Advantage Fund, Edelweiss Balanced Advantage Fund has grown in size, and we have seen the equity levels move quite swiftly when markets are trending and the trends are changing. So is a huge size or rising AUM size a constraint in managing equity levels swiftly?
Thanks, Niranjan. Obviously, our fund, if you will see in last 5 years, we have grown from 300 crore to almost 8,000 crore. But even now, you will see there are funds which are much bigger compared to our fund at current size also. So we are growing, definitely we are growing, but looking at the industry, there are funds which are much larger and still being managed efficiently. So I don't see we will face a challenge with increasing AUM. I think from 300 crore to 8,000 crore, we have already seen, you can say, huge growth. And we don't have to change a single process, what we were doing at 300 crore and what we are doing at 8,000 crore. Obviously, it is an, you can say, evolving category, and as and when we will grow further, we will keep on looking all the numbers closely. But as of now, I don't see that size will be a constraint because there are already funds which are much larger. And in fact, that larger fund will in a way provide liquidity to us because we are a pro-cyclical fund and most of the funds are counter-cyclical. So in fact, it will be like they will be providing liquidity to us on both the side. In increasing market, we are increasing equity, so we'll be buyer. At the same time, because valuation will be, you can say, expensive, they will be seller. So I think for us, it is not a constraint. In fact, for other set of strategies or other set of asset allocation, this can be a challenge because it is like 90% of the category will be moving into same direction. So I think being into a pro-cyclical approach helps us to solve that AUM size as a problem also.
Thanks, Bhavesh, for the clarity. The next question is for you, Dhaval. It's interesting question. The spread in the 10-year segment between Bharat Bond ETF and GSEC has shrunk from almost 40-50 basis point to 10 basis point recently. What's the reason for that? Another added question to that is, where do you see 10-year GSEC or 10-year yields moving in the near term? And the third question to that is, do you see there is merit in launching maybe 20 or 25-year roll down strategies and a good time to invest in them when interest rates are on the rise?
I think it's a very important question. So as I was answering in my previous session, the last 2 years, because of the COVID and because of other factors, we have seen a dramatic decline in the supply of the long end of the yield curve. The reason for that was that as the yield curve was very, very steep, most of the borrowers found it more convenient to borrow at the short end rather than at the long end to save that incremental 1.5 percentage point that they would normally pay as a premium for borrowing on the long end. So as a result of that, bulk of the borrowers remained concentrated at the 2-year and 3-year spot, and thereby depriving long-term investors like insurance and pension funds from long-term assets, their job is just to keep buying 10-year, 15-year assets. So what happened was that along with the inflows in the Bharat Bond ETF and along with the inflows in the pension funds and insurance funds, there was a big demand for 10-year and 15-year paper, but there was no supply. And that led to very dramatic tightening of the credit spreads. Currently, the spreads are hardly 10 to 20 basis points. As the RBI begins to embark on normalization, we hope that the fresh supply will begin. But in the first few days of the new financial year, the indications are that most of the CPSE borrowers want to focus on the 2-year and 3-year spot. And this is something that we are watching very carefully. We are hoping that the spreads will remain positive and not turn negative, because it can technically happen also where, because the insurance and pension funds have limits to buy assets, right? They have to buy a certain amount of corporate bond in their portfolio, and if they are not getting, they will probably end up buying more at a lower yield than the government bonds, because as the government borrowing has started, we are going to see some amount of uptick as the Reserve Bank of India is looking to normalize. So the 10-year yield, which was at about 6.44% in December, is almost at close to about 7.15. Which I think has few more basis points further to go. But and after that, in my view, it will become very, very attractive. So to answer your third question in terms of having a longer maturity, target maturity funds, we believe that we are getting into that zone. Now, at some point of time, perhaps in the second quarter or third quarter, when the yields will probably come very close to the peak, and that will become very rewarding for the investors to consider investing in 10, 15, 20-year kind of target maturity funds.
Thanks, Dhaval. Tridib, a question to you, a very interesting question. Someone just mentioned that the forensic part in your investment framework and philosophy is quite unique. Can you give some example? Of course, we cannot name the stock, which has helped you avoid any pitfalls in the recent?
How much time have you got? So I think it's been only 7 months that I've been in the system, and we've been sort of, we've articulated this sort of distinct focus onto that. And let me tell you, there are, as I recollect, 2 or 3 specific instances where we have avoided, a mishap. So in a guarded way, let me give you one example that we sort of kind of spotted and then let it go. So fundamentally, there is this company which is which is in the employment services kind of a bucket, and where the investment hypothesis on this company is that over the last couple of years, the company and the promoters have come clean. And when I say come clean, two aspects to that. One is they won't make any further acquisitions, number one. Number two, the historic acquisitions, there will be no write-offs, so to speak, that will happen in that context. So this was this was the background to that. Fundamentally, we did our numbers, looking at the P&L and the balance sheet, and we found out that the upside was coming around 30%. So we got interested, and then we got this forensic analysis done by a service provider who looks at slightly beyond P&L and balance sheets. And 2 or 3 things came about. First of all, over the last 3 years, the auditor fees has gone up something like 20 to 30% per annum. So that was the first red flag for us with regards to when we started checking that how come, you know, if all was good in the hood, so to speak, how come the auditor fees went up? Second, we noted the committee which decides on whether the acquisitions related write-off needs to be taken had 2 members. One was the promoter, and the other was his member of his committee, which overall goes on to show that the guy who makes the decision of the acquisition is the guy deciding whether there needs to be a write-off or not. So, you know, it can't get more clobbered than that, you know, obviously the objective decision making will not stand to happen. And third, when we looked at the board composition overall, the management board composition, we found that the independent directors, one level before, i.e. in the last 3 to 5 years, had worked with the promoter. So in many ways, you know, you could see that they are hardly independent. So based on these 3, and there was one more that they were in the acquisitions market, even though they claimed they won't do, we actually said that, okay, this is more than what meets the eye. Let's just leave it at that. And within 15 to 20 days, we had the CEO resignation which came about. And of course, he talked about personal reasons for leaving. But then they made an acquisition, the stock corrected 15-20%, and we said one of those deliveries which was well left. So that was clearly one example which was kind of, you know, which was quite stark from that standpoint. So in the interest of time, probably that's good to go.
Really
but,
well left, actually.
Thanks.
The next question is to you, Radhika. A very starking question is, you launched US Tech Fund 2 years back when, you know, FANGs were probably at their peak, because most of these stocks are now trading below their peak level, almost 30-40% down. So why did you launch that time, and, you know, what was going into your minds, and because the experience have been mixed?
Sure, and I think this is a good question. I think we have been believers of international investing for a long time. We were fortunate as Edelweiss Mutual Fund to acquire a number of funds. US Tech was not part of that list, but China and others were. And the team has been talking about international funds as a part of the asset allocation for a long time in 2017. Now, back then it was not glamorous to talk about it because there was a lot of domestic narrative. And we launched US Tech. In fact, outside of perhaps a single NASDAQ ETF that existed, US Tech was actually the first fund in the market. And while last year has been a fashionable year for NFOs, US Tech came in March 2020, just around the lockdown, when it was not very fashionable to do NFOs. I think we have a couple of things in mind. One, when we launch funds, we do think of timing, and we hope to be earlier in the cycle. And I know you asked this question in the background of the fact that international investing actually really took off last year, and the experience has been more mixed for people after last year. So US Tech's launch did well, and NFO investors have made money. Second, I think the fund we chose to launch, we did not choose to launch a concentrated FANG kind of fund. We felt that in disruptive tech, a couple of things are important. One, diversification is extremely important. So FANG stocks may be a part of US Tech, but they're a very small percentage of US Tech. And US Tech is very diversified. It could be 50, 60 names. Secondly, active management is extremely important in technology, because by the time a lot of stories make it to the index, they are extremely expensive or they have been discovered. And I think US Tech has had a history of catching some of these names early. So that was the logic of the US Tech NFO. And of course, like any fund, technology or any theme will go through volatility. But the fact is the timing, at least over the launch period, people have made money and it's playing across the market cap. It's a true blue tech multi-cap fund in that sense. And it's a diversified fund. And that was a very conscious call. I think when we look at any fund, even in the international space, we want them to be simple, we want them to be diversified, and we want them to be all-weather.
Thanks, Radhika. Bhavesh, last question for you. Edelweiss Balanced Advantage Fund is a trend-based fund. The underlying model is trend-based. Recently, we have seen markets have been quite volatile. There is no trend which we can see. So how do you manage these kind of market situation and how the return generation takes place in the fund?
So, Niranjan, as I said in beginning, 75% of the times markets are trending and less than 25% of the time markets are non-trending. So in fact, you will see in last almost 7-8 months, we are into that non-trending kind of environment where Nifty is starting from 17,500. We are still at that same level. This is not the first time where markets are non-trending. We have seen in 2018 also a lot of volatility. At that time, Nifty was trading around 10,500 to 11,000. Multiple times we saw Nifty went up to 11,500, corrected to 10,000, and finally ended the year with 3% positive return. We know that being a trend following fund, we tend to underperform, at least our model tend to underperform other sets of fund, but that is okay if you underperform, you can say 1 out of 4 years, because remaining 3 years are good enough to cover whatever loss opportunity you have. And within that also, if I take example of 2018, though it was not a year suitable to our style, Nifty was up say close to 3%, we delivered closer to 2% return. Now when Nifty itself will deliver, you can say plus or minus 3%, plus or minus 5% return, a good fund and a bad fund, or that means performance-wise, a good performing fund and a, you can say relatively underperforming fund will not have a material enough difference. So difference in that year you will see with the top performing fund, it was delivering close to 2.5%. We were at 1.9%. So 60 basis point of underperformance. And even in that year, our equity portfolio did well. So though we underperformed some of the, you can say, top performing fund, but we outperformed the category. Because in that year, most of the peers who missed 2017 rally loaded on mid cap and small cap to cover up that gap. And in 2018, we have seen what happened to the market. Nifty was up, say, close to 3% because of, like, US have FANG, we had our own Ritik environment at that point of time. So Nifty was positive, but overall mid cap and small cap were down almost 20 to 30%. So in that year, though the year was not suitable to our style and we you can say underperformed the category leader, but we were outperforming the category by almost, you can say, a couple of percent. So I think asset allocation may give you slightly lower return in that kind of environment, but if stock selection is good, you are into right sectors, I think performance will come automatically.
Great, thanks Bhavesh. And over to you, Radhika, for closing comments, and then we end this session.
No, I just want to take the opportunity to thank everyone, all the advisor and distributor community and investor community who has tuned in. I know it has been an extremely long session, but we can see people patiently hanging out on YouTube 3 hours later and passionately sending in their questions. So thank you for tuning in. If there's any part of the session that you have missed, we had a question on China, and if you've missed that, all of this will be recorded and available in part. So please do check out the videos. And of course, the team is there to answer any questions on our social media handles. So wish you all a wonderful weekend. And again, on behalf of all of us, many, many thanks for joining in today.